And we are live. Durable good order just came in. Pull this down a little bit. How's everybody doing today? What up, Norberto? All right, so we are, I got Roku up here, but we're going to be taking a look at the macro forces. We did just get some data that came in. If you want to see the charts, jump over to YouTube. We got the charts on at YouTube, and we will be showing the macro data. We have Fed minutes today, so we're going to find out exactly what language the Fed changed in their projections. We want to see what language they changed in their projections. So if you are on YouTube, you can see this chart FOMC. And we did just get durable good orders. Actually, you know what? The year on year is a little different. Let's see if we could find the year on year. I know that was breaking news. Durable good orders. All right, well, it's not there. Either way, let's get back to the chart. So what are we seeing? We're seeing a little bit of tightness come in from the macro forces. Bond yields, or the cost of capital, is still tightening up. And, you know, the Fed minutes are really going to make the difference here going forward. But until then, we do have the 10-year trying to break this trend to the upside. And we have the dollar still at that 103 level, still moving sideways. Remember, once we get over 105, that's going to be a risk-off signal, some type of, something's going on there that we have to factor in when it comes to the macro. We do have labor data coming in at the end of this week. So Thursday and Friday are going to be key economic data releases. Today is sort of just the FOMC minutes. We're going to see what they actually think. Other than that, I think we're still in the bear market. Just kidding. We're in a bull market. And if we look at oil here, looking at the top, I believe OPEC just cut production again. If we cannot get over the 75 level, it's pretty much lights out, right? It's pretty much lights out if we can't get over the 75 level. And inflation expectations continue to fall, pumping the market even higher. And, everything is setting up for a very bullish macro. We do have the VIX trying to make a move, finally make a move. It gapped up, but it's coming back down. It's really just the FOMC uncertainty that we're starting to see here. Bond volatility is really going absolutely nowhere. But for the most part, when we look at the overall trend, the S&P is still in an uptrend, still moving higher. And it's really going to come down to, how the Fed starts to see the picture going forward. Are they going to hike? Either way, the market is priced in that hike, or are they going to stay where they're at? So welcome to the stream. And yeah, we're going to be going over the macroeconomic data, how the macro is starting to shift a little bit. And also, how you guys doing there on YouTube? What do the technicals look like in the market? If you guys wanted me to do some technical analysis, go ahead and check it out. I'll be doing technicals on the YouTube. You won't be able to see it on TikTok, but you'll be able to see it on YouTube. And for, just looking at right now, if we go to crypto, just taking a look at crypto, I think this is probably the asset class that has the most to gain. It did move up. Crypto and Bitcoin in general actually had, a move higher before the stock market actually did. It led the stock market as global liquidity picked up, as we talked about in the last stream. Okay, we have Tesla also trying to break out from those deliveries. Tesla broke a record for deliveries, basically came in better than expected. Now it's above that pre-market high at 280. I'm not sure. It's probably going to need the Qs to continue higher, but we do have, like I said, a lot of these bigger risk assets, these stories of new technology still. AMD got to upgrade also. Excuse me. So the market is still very bullish, and we're just waiting on that labor data coming in Thursday and Friday. If it comes in kind of soft, it's good. If it comes in, stronger, it's still good. There's really nothing that can slow down this market, in my opinion, other than a black swan event. And where's that going to come from? We will find out. If you guys got any questions, let me know. If you want to challenge my view, I am very welcome to it. We are still we're in a bear market. We're in a bull market. We've been in a bull market, and it just continues from here. I think we see all-time highs by the end of the year, and there's a lot of factors that go into that. Now here on the YouTube charts, if you want to see the charts, like I said, jump over to YouTube. We're looking at S&P 500. It is retesting the previous highs. We could just be consolidating sideways until we get a little more data into the market. Other than that, still holding the previous highs, and it's still, that this kind of technical price action is very bullish for the market. Qs, looking at the same thing here in the Qs, the Dow is Also consolidating at the highs. Dow has a little more room to run. IWM overall is probably still in the bear market. Technically, it's still down 20%, but it has been moving up lately. It's had a lot more strength than the other indexes. ARK is near breakout mode, and when ARK goes higher, ARK's probably going to get, it's probably going to go high. It's probably going to go higher once Tesla starts to break out again. If it does, I believe it does. If the Qs go up and ARK also goes up, pulling up those other assets that they hold. I think Zoom is one of the biggest holdings they have. Unity Software is also another one, but either way, look out for ARK. ARK is just a proxy for the riskiest of risk assets, right? It is a proxy for that. The exponential age or the innovation fund is what people like to call it. So keep your eye on that. We might still have a little more room for consolidation, but in the short term, it's all noise. We really want to know is inflation coming down, and we're going to get that reading coming up here in a couple weeks. And I think the numbers are going to be low because, again, oil's been low, shelter's starting to come down, and core is just not as hot as people believe it to be. The labor market is still strong but not collapsing, and that's been the narrative. Nothing's really changed. It's kind of boring, but we definitely are moving higher. Sure, man. Yeah, you can be, I don't know what that means exactly, but jumping over here to YouTube and throw your comments on YouTube. We'll see what you have to say. All right, so we're going to look at the intraday. I'm going to zone in here a little bit. We'll go to the 1 minute chart first to look at S&P 500 to see, actually, let's go to the 30 minute. We'll look at the 30 minute to see where how the market is actually moving. Where are we coming from? So we had that downtrend that started in mid-June, right? Mid-June is where we peaked out first for the S&P 500 here. And we had a downtrend for a while. It was a blow off top. We moved up pretty quick. A lot of people getting squeezed. A lot of shorts were getting squeezed. They had to cover their positions. We went higher. Breakout traders came in. And also a lot of people that had cash sort of started piling into the market. That's the narrative. And now we're breaking that downtrend. We found support at 432 on the S&P, on the SPYs. And we broke out. We retested last week a couple times. We retested the highs. And today we had a little gap down. But if Powell comes out, and Powell at the end of the day, and this is going to be a little later, 2 this is going to be 3 p.m. I believe 3 p.m. No, I'm sorry, 2 p.m. It should be 2 p.m. Eastern time. That is 11 a.m. my time. Powell should come out. Now, we'll see if we can get past these highs, if we can break out. If so, I think Amazon has a lot of room to the upside. Look at Amazon. It's been consolidating, especially after that news. And once you get over 131 and start holding for Amazon, you're pretty much breaking out. You have a little bit of resistance up here, but this is a big AI play. So keep your eye on that. Tesla's pulling back into that 280 level and had a huge 6% gap up earlier this week. And Tesla's one of those moves that can go to the highs in my view. Also, Nvidia came back down to that 420 level, the previous breakout, and now it is moving higher off that previous high. You can see that 420 move. It had a nice rip this morning, so it's starting to break out. Nvidia, people are still piling into Nvidia, and this AI theme is really going nowhere. Powell isn't speaking. No, just FOMC minutes. He's not speaking, just FOMC minutes. So, the conglomeration of we're really looking for, did they change their language? Did the FOMC, did the Fed change their language on anything? They did last time. The last time we did FOMC minutes last month, they removed further restrictive territory, or further restrictive their further restrictive stance. They removed that, and the market was pretty bullish after that because basically they're signaling the pause. That's what we said. And what do? We got the pause. We actually did get the pause. And so now we're on pause, right? We are on the pause. So the next question is, do we see the pause continue into July? You hear a lot of, there you go, Tesla's coming back down. I don't think Tesla can break out yet. I think it needs some time to consolidate. Can the pause continue, or is it going to, I know a lot of people think they're going to hike rates no matter what. They're going to hike higher. Well, not really. I mean, you really don't know what they're going to do. You just have to watch and see and keep your eye on the data. The The labor market data is going to be key. Microsoft, please, viral videos. Are you on the YouTube? Jump on the YouTube. Missed my meta breakout today. Oh, okay. What up, Norberto? Shout out to you guys that made it on here. I got some features on here finally. So you guys can hear that, right? Good, good. Shout out to you guys that made it on here. Appreciate you, chat. So we can look at Meta, and if you are on the YouTube, let me know. Say something on the YouTube so I can check you guys out. Pal isn't speaking. Microsoft. Hey, Microsoft actually looks really good. Microsoft is looking pretty solid. It definitely is trending up, and it broke out of this descending wedge. Should I take the pre-market off? No, I'll keep the pre-market on, but it is holding these previous highs. Let me go to the 1 hour chart. Okay, it's holding these previous highs. I'm actually liking what Microsoft looks like right now. Is that 338? That's like the 338 level, right? We are holding above that. This morning we got above that level, but again, it's always key to keep your eye on the overall market. And I don't think the overall market's going to make a move higher until the Fed minutes come out, until that uncertainty gets resolved. So we'll see how that plays itself out. Stocks and charts are voodoo and tarot cards for men. Cool. Yeah. I mean, that's your opinion. A lot of people use charts. You know, if the price just keeps going higher, price is really just a reflection of sentiment. So you can be bearish all day. You can look at the fundamentals. It really doesn't matter. What matters most is, do you see a trend, right? Do you see a trend, and does the macro align, and do the fundamentals align with it? So I know a lot of people don't believe in charts, and that's completely fair if you're a beginner. But if you understand how the market works, then you would know that the charts are a reflection of human psychology, right? So when you get a short squeeze, the price goes higher. That short squeeze fundamentally is showing that there's a lot of people lined up on the short side. What up, Bukowski? A lot of people are lined up on the short side, and then the price actually squeezes. That is your confirmation that they are covering. So the charts are very, very important for a lot of people. Some people don't really care about the charts. If you're a long-term investor, you really, it's smart, because when you're using the charts, you want to buy on huge dips. If you're a long-term investor, you don't want to buy things at the highs, right? So the charts are, I would argue, are very important, but people buy into the charts too much sometimes. A pattern isn't really going to tell you if the sentiment is strong. If there's a good narrative and a good catalyst to the upside, and you see like a bear flag or something bearish, it doesn't matter, right? So you want to add all those things together: the fundamentals, the macroeconomic backdrop, what is policy looking like, right? What are the risks? And then also, what are the technicals? Are the technicals lining up? So I'd argue that, yeah, charts are not just voodoo, but hey, fair enough. Pause rates, then days later, they say they need to be more restrictive. Yeah, I think they're just playing a game, honestly. I think they're playing a game, Tony. And I'll check out Meta too. So keep your eye on Microsoft. I just don't think we see a big move today. We'll keep our eye out. Could be wrong, but it's going to happen probably second half after those FOMC minutes are released. They'll come out pretty quick. Either way, yeah, we're taking a look at that. So pause rates, then days later, they need to be more restrictive. I think they're really just managing expectations, right? They don't want to kind of give their hand, but their hand is basically, as growth slows, they're going to have to cut rates, right? At some point, once growth gets, to levels where GDP is starting to fall, and actually GDP is strong. So I think it's stronger than expected. And I have those charts up. If you're on YouTube, we can look at those charts. But GDP came in stronger than expected. So I think this pushes them to actually hold the 5 to 5.5, 5 to 5 and 5.25 hikes. I think they can hold them there. So I think we pause longer because growth is pretty strong, right? If growth was coming in below expectations, then we probably would see a prolonged pause, or you can assume we're going to see a prolonged pause. But for the most part, we're already in restrictive territory. Inflation is coming down pretty quickly, regardless of what people think. I don't think people really understand inflation to that degree. Do I know everything? No, but I'll give you a very good analysis of what's happening with inflation. For the most part, at different parts of different regions, basically the different components of inflation, most of those components are falling apart, while some of them appear sticky, but those are lagging parts. So for the most part, inflation's coming down, and the market is sniffing that out. That's why it's moving up much higher than expected. And if it does stay sticky, that also speaks to earnings, that earnings are going to remain a little better than expected also at the same time. So, hi, how you guys doing? Good morning. Big man's coming. What up? Institutions a lot of the time have open orders down low, and charts show that. Yeah, yeah. Some people are silly, man. They think charts don't matter. I mean, it's kind of silly to say that if you have the view that charts are not everything, and that yeah, that's true. Charts are definitely not everything, but charts are giving you some more data. It's almost like saying, I'm going to drive blind on the road because, the road, the way people drive, they're not perfect, right? So you have to keep your eye out for patterns that change. If somebody's swerving on the road, you might want to move out of the way. And the same thing with charts. If you're shorting the market and all of a sudden, the chart is showing that price is going higher, you're going to get crushed. So you got to have a stop. So it's just silly to think charts don't matter at all. Anyways, this is Microsoft. Let's check out Meta. Oh, yeah, Meta's breaking out. So you guys did miss that Meta breakout this morning. Meta's just slowly been grinding higher. It has not slowed down. So this is a new 52-week high on Meta over that 290 level. Let's kind of zoom in there and see what it's looking like. We got Tesla off PDC above VWAP again. It looks like Tesla's about to break out. A lot of demand there that it just grabbed at that 280 level again. So Tesla looks like it's just going to keep ripping. It's going to keep ripping higher. So far, fear and greed index. Everybody got their yeah. Everybody is bullish now. A lot of people are getting sort of bullish, but you know what? It's really silly because you can stay very bullish for a while. When you're this low into the market, when the narrative starts to change and people are still low on, or people are still bearish, it doesn't matter how greedy people get because most people are still, a lot of cash is still $5.5 trillion on the sideline still in cash. If the market was near all-time highs, I think the greed would be a negative signal, but at this point, it's a bullish signal that people are greedy. It's a very bullish signal because price matters, right? If Tesla's at all-time highs versus, down 50%, and that's going to be a big difference in sentiment for where the price is at, because most people want to buy lower, not higher, but that's not true. Some people will buy higher. When I say all-time highs, it's breaking all-time highs, not near the breakout. So again, you just want to add all the variables together and before you really make an evaluation. So definitely right now we're getting a more bullish backdrop. The Fed is on pause, inflation's coming down, the economy is not collapsing, the economy is pretty strong. The housing market is also starting to recover to some degree. Non-residential construction builds are skyrocketing. And so building is happening, and a lot of that's due to the fiscal policy that we've been seeing. Big money is, what do you say? Tell them it's positive outlook on the market for it to rub off on you in your investments. Okay, yeah, for sure. For sure. So anyways, yeah, let's do the technicals really quick. Big man's coming. Appreciate the comment. Like I said, I have the charts over here. QQQ starting to break. There we go. QQQ is now going to retest. So the top of this channel is actually the resistance, the previous high. S&P has actually been leading the Qs. And so now we see the Q starting to pick up again. A lot of bullishness in the market. 371. So the Qs are picking up. That's probably what's picking up Tesla, Nvidia. AMD, like I said, got that. AMD had that huge, or had an upgrade today, but it is pulling into the previous support that broke. So this is a big level. AMD needs to really hold above the previous level to. I'm pretty bullish on AMD in the intermediate, right? In the short term, maybe over the next 3 to 6 months, I think AMD is going to be strong, but we do need to break above 117 and hold. You can see on this chart, the last time when AMD really started to flush, it broke below 117, 118. So yeah, 117, 118, we need to hold that before, because we could just flush all the way back down to the trend for AMD. That's definitely something that can happen. So you got to keep your eye on that. But I like AMD as one of those swing trades because I think we're in a swing trade environment right now. See that previous support that broke below. So we'll keep our eye on that. A lot of confusion, broken testicle. Yeah, what are you confused about? More knowledge you have and a potential for positive mind growth mindset happens. Yeah, let's go. Yeah, you got to stay positive, man. You got to stay positive. I mean, we're coming from the lows. Dang, Tesla's looking good right now. Just broke that trend, starting to lift again. and a lot of people are going to chase this. A lot of funds are going to have to chase this. So you want to keep your eye on that. Anyways, AMD, I want to just point this out early. AMD is extremely tech. It's a really good setup. When you look at the macro, you look at the overall market. Nvidia is also a good setup, but AMD is that second tier play for the chips. Micron sort of is having a couple regulation issues in China. And AMD is coming out with a new chip pretty soon. It did sell off and it had that large flush. So technically it is pulling into the trend, and it had some trend, well, not trend support because we just drew this trend, but it did start to break out again. So I'm looking for a pullback on AMD. Another big play, and I'm just going to point these out really quick. MicroStrategy, looking for the pullback on MicroStrategy, possible calls because it's front running Bitcoin right now. Are we going to get the ETF is the big question. Sure, I think we do get that ETF. I think we end up seeing that come online for sure. BlackRock is not going to get denied an ETF from the SEC because basically they're the same entity. The government and BlackRock are pretty much close friends in my view, for a lot of reasons in the past. So, okay, Open Door, we talked about Open Door breaking out of that trend. It is now holding 4. This is good. If you get a pullback on Open Door and a hold, then that should be, another reason that you could enter. But obviously the entry was better down here. A lot of short positioning. ZM, still keeping my eye on ZM, waiting for this thing to break out. It has a lot of upside. A lot of people are still using Zoom. Their revenue's still straight, but earnings are probably going to move this thing before anything. Palantir also pretty good setup there. Let's see. But anyways, yeah, looking at big tech in general, they're all just moving higher. There's really no stopping them. Yes, Microsoft is strong. Microsoft is looking pretty good. I think Microsoft has a good setup here. So we're taking a look. See how it's hugging that trend? It's just been hugging this trend for a while. For the last, I'd say like the last couple months, it's been hugging this trend. So now it is starting to break above that resistance level. You just want to see a little more hold there, and then Microsoft's probably off to the races, right? It's probably off to the races. But again, we have to keep our eye on the Qs and the S&P. Once the S&P and the Q, and it looks like the Qs are going to press that today. Once they get above their resistance levels, then we're going to see a lot of more. I think it's wave 2 FOMO. I've been saying this for a while. I think we get wave 2 FOMO. You're already getting it in Tesla, wave 2 FOMO, and we go much higher. Amazon still hasn't made a big move. It really hasn't made a big move yet. So we have a lot of room for Amazon to fill the previous highs, where a lot of stocks are already up there. So Amazon, Tesla, I think have the most potential. Is it overbought? Yes, but we're coming from the low, so you can stay overbought for a while. You've seen it back. You saw it back here in 2017 when Trump cut taxes, and that was basically fiscal liquidity. We're still getting fiscal liquidity, and you can stay oversold on the RSI for a while when you're coming from the lows. That is, that definitely can happen from a technical standpoint. And the AI theme is still strong. It's not going anywhere. It's definitely not going anywhere. And now we're getting this crypto, this bullish crypto start to pick up, and people are getting risk on inside the markets, right? Hedge funds, whoever it is, they're starting to turn a little more risk on because the risks are starting to disappear. Even if we look at volatility, most of volatility, which we didn't even look at on the macro, volatility is falling. Volatility is starting to fall. We can go over that. And that's another indicator that we're headed into a secular bull market, right? The VIX just, pretty much depressed, going right back under 20. Above 20 is really vital for the VIX. If you're trending under 20, then the cost of insurance is lower, or the sentiment for risk on is stronger when you see the VIX that low. When the VIX starts spiking, people are a little more worried about, getting risky because the geopolitical backdrop, the macroeconomics are kind of falling apart, but we're not seeing that. You look at the MOVE index, this is bond volatility. This is key for lending. The higher the bond volatility, the bigger interest, for people who own treasuries, who lend out money, the higher the bond volatility, the more they have to hike their rates or tighten credit conditions, because their treasuries are, their U.S. treasuries, which are the collateral for any type of borrowing or lending. They're a little more volatile or uncertain, So if that bond volatility is coming back down, then that's also risk on for the market. That's good news for the market. Triple B spreads. I mean, we're not going to go over all this, but triple B spreads are also coming down. So this is a signal for me that there's still confidence in the equity debt market, right? So people are still buying the debt from certain equities, not all equities. Some of them are not good, but if you have a good balance sheet, they're still buying it overall. So a lot of risk on behavior taking place here. And if you go overseas, you're seeing the same thing. Japan stimulating, they're in QE, and China is also in QE. So we got strong macroeconomic backdrop here. The dollar is, ooh, man, this is setting up though. The dollar is really setting up. I think this is one of the final legs, whether we get the dollar breaking out. I don't see that happening or the dollar breaking down. And if the Fed continues to pause, we should see the dollar slowly start to come back down. What else do we get here? The bear, I will buy dinner. I want cheap shares. What are you looking for? Microsoft? You think capital flows into BTC and then ETH? Do I see capital flows into, do you think capital flows into, oh, okay. Do I think capital flows into BTC and ETH? Yeah, that's a good question. Let me get to these comments really quick, and then we'll go over BTC and ETH, because the ETH to BTC chart is still setting up. You know, a lot of people don't like it because they think, you know, this is voodoo, I guess, but this is this is a huge bullish wedge pattern, and this is basically Ethereum versus Bitcoin. If this thing starts to break out again, well, you're expecting Ethereum to outperform, and ETH has a lot of upgrades that it's starting to get for the DeFi, or the token, is for the ecosystem, for the crypto ecosystem. This is the platform or the backdrop for all Web3 / tokenization to happen on the Ethereum network. It is nothing like Bitcoin. It is completely different than Bitcoin. So they're not the same. They don't compete. And this could catch a lot of momentum going forward. And we'll see how that actually plays out. But yeah, I think a lot of capital is going to start flowing in. Right now, Bitcoin dominance is a little stronger, though. We're getting a lot stronger Bitcoin dominance than we are ETH. But let me see. This is the Bitcoin dominance chart. Yeah, we're still moving up in the Bitcoin dominance chart. Once it starts to slow down and overall risk is picking up in the crypto market, then ETH probably starts to take off again, because most of DeFi is built off Ethereum. In general, not all of it, but in general, you know, ETH is the strongest network. What else do we got here? What up? What up? Okay, yeah. Anyways, yeah, if you want to see the charts, jump over to YouTube. That's where we're showing the charts at. We are looking at those charts on YouTube. Any traders in the chat? We got any traders in the chat, or just market participants in general? Here's another thing. This is the just so you guys know, TLT is the bond ETF. This is for the actual bonds. Excuse me. So TLT is the US Treasury bond ETF. And what's important about this chart is it sold off at a record. Like, this was here we go, TLT, there you go, US Treasuries ETF. This thing sold off, had the biggest drawdown in history. And I thought it was going to bounce because bonds bid up when the economy starts to slow. And we've been seeing that, but bonds can't, they can't catch a bid because inflation's been elevated. But now the inflation rate is coming down and bonds are still not bidding up. And I think that's because, the economy is now not really looking like it's going to collapse. So there's more risk taken. We're seeing more risk flow into the stock market in general, or into risk assets in general. And so keep your eye on this ETF, TLT. This is the inverse of bond yields, or risk taking. So I'm starting to change my view on this. Maybe it just stays down here for a while, because why buy bonds when when AI is going to give you a much better return? Maybe you have it in your portfolio for a little bit. It's obviously going to give you some yield, but why buy bonds when the stock market's going to return you a lot more, right? So that's something interesting there, and we're keeping our eye on that. Web3 backed tokens are useless. Most of them are. I agree. Most Web3 tokens are useless. I agree with that, Sebastian. Check out pinned ETH vid. You'll love it. The pinned ETH video. Did you pin it? Pinned ETH video. Not sure where you got that from. Maybe you pinned a video. I didn't even know you can do that. Anyways, yeah. So we'll keep our eye on that. Now, for you, those of you on YouTube, I just want to reiterate sort of the macro as we head into these Fed minutes. I'll put the S&P back on here. SPX, like we're in a bull market. We're still in a bull market. We Tom Lee believes we go to all-time highs, and it looks like look how close we are from the all-time high. Sorry, I zoomed in there a little bit. Look how we're still not even, if we look at the weekly chart, we're not even overbought yet. We still haven't hit overbought territory on the S&P. The Qs have, but not the S&P 500. And we still have some room to go, I believe. So we're headed for all-time highs this year. If you disagree with me, let me know and tell me why you disagree with that. There's a lot of unsubstantiated bear market claims out there. Like people will point out one thing. This is like 2001. This is going to be worse than 08. Okay, tell me why. Tell me why this is like 08 or 2001. You know, if anything does fall apart, the Fed can quickly cut rates, right? They can quickly cut rates. Okay, let's say they don't cut rates. Okay, well, they can inject more liquidity as they did earlier in the year in March when the banking sector had some risk. So they can also do that too. Oh, okay, well, what if they don't? Well, you got fiscal also. You have, the White House also spending government money, which is why construction spending is going up, because they keep spending while Tesla's forming a gigantic intraday wedge. This is a very powerful pattern. If we get the Qs break out today, this is going to be big. I'm always keeping my eye on these patterns here. So yeah, we are moving up on that. But I did, like I said, I wanted to show you guys here on YouTube really quick the macro charts, probably the most important macro charts that I'm seeing. We had the ISM business activity index come out a couple days ago, and this is really good news. So this is what it looks like, right? This is the ISM index. Below 50, your economy is starting to contract. So the economy is falling apart, or it's in recession territory. Under 50 and below 48 has always been a recession. So I think we're already in a recession. It's just a rolling recession. It's not this deep, collapsing recession, but it's been in financials. It's been in technology. We had a lot of job shedding happen in the tech sector, in the banking sector, in the obviously in the manufacturing sector, in the housing sector. We've had all that. So the ISM manufacturing side of activity, because there's two parts of the economy. You have manufacturing and you have services. Services is still expanding, but the manufacturing sector is not. But we're starting to get, if we dive deeper into it, we're starting to see the data start to improve. And here's what I have highlighted. New orders month over month from May to June actually went higher. So demand is picking up. It should be collapsing, right? If this is a real deep recession, we should be seeing demand collapse, and we're not seeing that. We're getting demand start to pick up. Supplier deliveries are another one of those indications of where the manufacturing sector is headed. That actually picked up month over month for supplier deliveries. And I think this is coming from the fiscal liquidity that we're seeing, right? The government spending for the Inflation Reduction Act, CHIPS Act, weapons to Ukraine, whatever it is. Either way, the economy is still turning up in recession territory. When it comes to, we should see it collapsing if it was really bad. It's not happening. Inventories fell. What does that tell you? That there is buying happening. If inventories are falling to some degree, then that's also a bid for growth, or it's telling you that those inventories are starting to get bought up. There's some movement there for the manufacturing sector. Now, here's the big positive news. Everybody says it's inflationary. Everybody thinks everything's inflationary, but the prices paid for the manufacturing sector, or the supply side inflation, is non-existent. And we're getting prices paid also drop. This is a plus. It didn't go higher, but this is a plus because it costs less to do business. That's basically what we're seeing here, is that the price for manufacturing, the price to run your business is not accelerating. It's actually falling apart while demand and while new orders are picking up. So that's really good news and this isn't a great report. It is still in recession territory, but that's one half of the economy. And when we're looking at the micro data, well, it's picking up. It might be decelerating, but it is picking up in some areas. And maybe that changes next month. Maybe it does fall a little bit, but that's why we track it month to month. Okay, that's why we track it month to month. Here's the month-on-month construction spending for the last 3 months. For the last 3 months, construction has been climbing, right? Why is month on month, if we're headed for this deep recession, and I would argue the manufacturing sector is starting to recover, or the parts of the economy that were very weak are now starting to recover, and we can see that because the government is spending, construction spending is starting to lift, and housing starts, housing construction, pending home sales, they're all starting to lift from the lows. Can they roll over? Sure, but on this coincident data, this month-to-month data is showing us that the economy is starting to strengthen. Yeah, you're welcome, bro. And then at the same time, we went over this last week, but GDP growth came in better than expected, right? It was expected to come in at 1.4%. We are decelerating, right? Duh, we're decelerating because growth is slowing. That's not terrible because we need inflation to come down. And by the way, you can't get growth without inflation. There's always inflation in the economy, in the fiat system, the system around the world with central banks. You need to stimulate inflation to get growth going. It's called debt. You use debt, you take out debt to stimulate the economy. And so you're going to have somewhat inflation, but we actually want slower growth for a while to sort of cool. What is this? Okay, to sort of cool down, the economy to some degree, and we're getting that. But the positive here is that even though things are cooling, it's still better than expected. So I think we're starting to bottom. To me, that's a signal because you're expecting a crash or you're expecting a fast deceleration, and it is decelerating, but we start to pick up, right? We're starting to come in better than expected. It's like momentum is picking up while we're decelerating. Well, I think over the next couple of quarters, we actually do start to recover, and you see we're already seeing earnings revisions start to pick up. Now, the biggest news here, and a lot of people don't understand this, what you got to know here is that the RRP here in the red, the reverse repo facility, it has 2.5 trillion. The reverse repo is basically this facility where there's a bunch of cash being parked at the Federal Reserve. So to me, I think of this as a cash cushion for the economy. So take a look at that. If you're on YouTube, you can see it. This is the reverse repo facility, and the reverse repo facility has been piling up for the last couple of years, and a lot of cash is in there because the Fed is paying interest on that cash. So if you park your cash there, then you get paid interest right near the Fed funds rate. And now that cash is starting to drain because it is starting to drain for a couple of reasons. But the important part is that is a lot of liquidity to actually back the financial sector or the capital markets. It's going to back the capital markets if it starts to drain, and that's what we're starting to see. So who puts their money there? Money market funds. You guys have heard the money market funds, all-time highs. They're going high. People are parking their cash at the money market funds. Yes, they are, because the money market funds are collecting cash or interest at the RRP, at the reverse repo, and they're paying that interest to the customers, but now they're leaving the reverse repo to go buy treasury bills. So all those treasuries that were created during the debt ceiling that were supposed to drain the banking sector is not happening because they're coming from the RRP. They're coming from the reverse repo facility. And my expectation on the optimistic side is that if something does kind of fall apart, you can target again those short-term treasury bills. When I say target them, you can just deploy a little more U.S. Treasuries at the low end of the curve and suck more cash out of the reverse repo to support the market. So as the TGA, and I'm going to get off this, as the TGA or the cash at the Treasury starts to get filled again, you're basically giving money back to the U.S. government so they can start spending again. So it's a whole nothing burger. If they keep spending, won't inflation spike up again? Not exactly. And a lot of people argue with that. Or a lot of people think, hey, if the government keeps spending, won't inflation go higher? There is a scenario where that does happen. Okay, I'm going to remove this now. There's a scenario where that happens, but it's very unlikely right now. It's very unlikely that inflation goes higher just because the government is spending. There's two keys to inflation, by the way, and a lot of people just don't say this. So I'm going to focus this in here, okay? And I've heard this so many times, okay? Inflation is either goods inflation or asset inflation, right? Inflation comes from it manifests itself in two ways. It's either going into assets, going into goods, or both, okay? Over the last forever, the government has been spending, but we haven't had inflation since the 80s, right? So why aren't goods inflating at an exorbitant level, 9%? Because supply side dynamics have kept inflation tame. And what that means is the more you produce, the higher your productivity levels, or the more supply you have, the more it combats that demand, or that demand side inflation, right? And this is for the goods, not for asset prices. Asset prices always go higher when the Fed prints, when the government spends. Asset prices are going higher, which is why it's so important to invest and to educate yourself, because you can't beat the system but own the best assets. That's the only way to really beat the system without even looking, right? Without having to go. If you're just a normal guy and you want to, and you're just a normal person, right, guy or girl, whatever you are, and you're like, how do I beat inflation? Well, you got to own the best performing assets to beat inflation. Your wages are not going to do it, right? Prices on food and property, energy, they're always going to go higher to some degree. Now, the reason I point this out is because people think, okay, well, if the government spends, isn't that going to be negative? No, because if they're spending goes into, if it becomes productive, if that capital goes into supply chains and goes into producing more goods and services, then inflation doesn't go higher. So that's where people get confused. They think, oh, well, if the government keeps spending, that's, and I'm gonna have a podcast pretty soon to explain this to people. Uh, and it doesn't mean I know everything. This is just the research that I've done and understand how things work, which is you have supply side inflation and you have demand side. The pandemic was so terrible for inflation simply because you had demand explode and at the same time supply decrease. And that's a double whammy for inflation. That's why we got record high 50-year high inflation, because demand was up. So that's pressure on prices up, right? So much money, more money chasing less and few goods and services. And then you have the supply side or productivity drop because the lockdowns kept people from working, from producing or supplying. So the prices went even higher, right? So inflation manifests itself in two ways. Like when I say inflation, I mean high inflation over 2.5%. And it is extreme demand and extreme supply, or I'm sorry, a lack of supply or lack of productivity. But if you have demand move up and productivity move up, it's a nothing burger. Inflation doesn't really move higher. You need one or the other. You could have demand level, and if the supply drops or supply chains come off and demand doesn't move up, you might have a little bit of inflation. Okay. So point being, inflation doesn't move higher because the government is spending. It moves higher, or simply because they're producing more. They're more productive. Productivity is the key for all economies. That's how you grow GDP. And without increasing your debt is more productivity. So producing more at a cheaper price. And yeah, let me get back to those charts. So that's the key to inflation. It doesn't really just move higher. You're not just going to get higher inflation just because the government spends. The way that inflation gets out of hand is when the banks lend a lot of money at zero rates. That's also super inflationary. So when the Fed prints, it's also not inflationary when the Fed prints, unless that money that they print, because they're printing that money, they're not giving it, they're not handing out to you, right? They're not giving the money into your hand. They're not printing money. Here you go. Here's $10. None of us got $100,000 or $5,000 or $1,000 in our hand from the Fed. What it does, it goes to the banking sector first, and the banks, it manifests itself by them lending. But the banks are not lending how they did because we're still in a slowdown. There's a lot of risk economically, so the banks are not actually lending. And what that means is the Fed can keep printing without it being inflationary. And they've always been printing. So it's just not inflationary unless the banks come out here and start lending at low rates. Then obviously people love leverage. They're going to spend more. They're going to buy more stocks, XYZ. Now, who cares if stocks go higher? That's the inflation you want to own, right? You want to own asset inflation. You just don't want to own goods inflation. And so that's the key for inflation. To make it simple, right? Inflation is not going higher because we have enough productivity. We have enough supply coming online. China supply chains around the world, those supply chains are good now. They're strong. They're happy. Not they're happening, but they're filled. They're not paused. People are, like I said, the supplier deliveries are up. New orders are able to get pushed through. So because those orders are pushed through, it can match the demand and keep prices even and balanced. All right, so yeah, back to the S&P 500. I don't know if you guys, I just wanted to mention that because a lot of people really think that inflation is just going to go higher because any bit of money that is spending, like we need to just not spend it all. If we stop spending, we're going to collapse because growth is already slow. The birth rate is low. The way you get GDP up is population growth. We don't have that. Productivity, we have not had that for a while, or debt growth. So we've been using debt growth for the longest. We keep growing our debts, which is why we're at 31 trillion. And most governments are double, their debt to GDP ratio is double, meaning they have more debt than they have GDP. So, like I said, they're going to have to always print. The key is when they print that money, is it going to be productive spending, as in creates more productivity, or is it just going to go to pure spending without people working? So you want a strong labor market. The stronger the labor market is, the better, because people are going to produce. You have stronger supply chains. You have stronger, more productivity. Maybe that was confusing, but I just wanted to get that off my chest for these inflationists who believe everything is inflationary. And usually it's just because they're not in the market, so they're like, "Oh, market has to rip lower, it has to come down." I don't think so. E30, bro. Rick, what is he saying? Didn't know Bud were traders. Didn't know Bud. Because he's probably talking about the guy earlier. All right, cool. Back to the. Let me see. Let me pull this in. So yeah, Bukowski. And the spending is not going to spike inflation. The only way you really get inflation to another, and it's a lot of things. So I'm just trying to bring some education. You can't get inflation rising in a slowing economy. It doesn't happen. You don't get inflation rising while the economy is slowing. You actually need the economy to GDP growth to start picking up. We saw the downtrend. When that trend, if that trend is moving up, and GDP is accelerating, now you have a chance for inflation to start picking up again. But we're still decelerating, which is a good setup for inflation to keep falling, right? It's a good setup. And the next thing you want to look at is oil prices. And this is key to me. I've said this for the last 5-6 months, that this is the most important chart. And now you have OPEC, I believe it was OPEC, cutting production again. So they're trying to get those prices up and they just can't get, look at, nothing's happened. Oil is not going hard. Oil is not going higher. So they're cutting production. It's not happening. Why? Because demand is falling. How do we know that? We look at the ISM leading indicators, the manufacturing activity for the world in every single region, Europe, US, North America, South America, Euro-Asia. They're all falling in their manufacturing productivity, meaning all their manufacturing activity that leads the global economy is still not strong. So that's less demand, right? That's just purely less demand. There goes Tesla failing. That's what I want to see. I'm bullish on Tesla, but I think it needs to consolidate a little longer. Anyways, yeah. So that leads to lower demand. Plus, all of you guys are virtualized now. Like nobody's going back to the office. Commercial real estate's falling apart. That's less travel. If you had to travel for business trip, well, you don't got to do it no more. So that's less demand, right? For travel, whether it's an airplane or whether it is you're driving a car. That's just purely less demand. So the demand for oil, I think, is just going to continue to fall, at least for the next couple months or 3 months. And I think we go into the 60s or the 50s. I've said that multiple times. I could be 100% wrong. Maybe the demand for summer travel picks up, but I think you also have that balancing out because people are not traveling for work as they did before, and people are saving. We see the savings rate going up. They're spending less because they're afraid. Dang, a lot of people got shooken out there. They're afraid of an actual recession or collapse. So the fear, and this is why the Fed manages expectations. The fear alone keeps people from spending more. I guarantee most of you in the Discord, not in the Discord, most of you are spending less because you're worried that something might happen, right? Your stocks are down, your assets are down, your investments are down, you're worried about losing your job possibly. So you're going to spend less. You're watching your spending, and that fear alone is going to slow demand at the same time. So once we get this collapse in oil, there goes inflation down to 2%. If you didn't hear it nowhere else. You heard it here. I am calling for a 2% inflation within the next couple months. Headline CPI, by the way. So we're in July. I say August. Actually, I did say July or August. We'll see 2% CPI. Headline CPI. Core is a little different, but headline, that's enough to get the market going again for sure. Are you on Discord? We have a closed Discord. We're thinking about opening it. I'm not sure yet. But what we do have is I have a newsletter. If you want to check it out, link in the bio. I send it out every single week. It is a newsletter to inform you on the macro. If you didn't catch the whole stream, then you can catch the macro newsletter. I go over it on Saturdays also. and a video on YouTube. Subscribe to the YouTube channel. You're going to get all of my content on there, which is what is the macroeconomic backdrop? How is it improving counter to what you hear? You hear inflation and the recession and all this stuff that just doesn't add up. And I'm going to prove to you why it doesn't add up. Inflation is coming lower and the economy is starting to bottom a little bit, right? So we're keeping, and we keep track of that every week because things can change. We could get a change. Maybe, maybe I don't see it happening. Maybe China invades Taiwan. I don't think it's going to happen now. That would be a very risk off, signal there. Maybe consumers start to collapse. I don't think it happens, but that would be another signal there. So we're watching the day-to-day data in consumers, right? Consumer strength, retail sales. So how strong are consumers on a month-to-month basis? We're looking at the manufacturing service economy also. Is it in contraction? Is it falling or is it improving, right? Look at the housing market that's starting to bounce. And we look at Fed policy. What is their policy? What are they actually doing? As much as you hear the Fed is so tight, they're negative, they're hawkish, bro. They are still printing money. They are still printing money. It's called the BTFP, which is the Bank Term Funding Program. It's called Fed liquidity, and they are injecting liquidity into the markets. So as much as you hear that they are in QE, there are QT, quantitative tightening, the only thing tight is rates. And that's actually ending because they just paused. And hey, from here on, over the next 12 to 18 months, they're more likely to start cutting rates as inflation continues to regress or remains as tame as it is. So the cycle is starting to turn. The hiking cycle is turning, and the Fed is becoming they're trying to stay hawkish, but I think they're going to become a little more dovish, or they're going to start easing further. So we're really easing. They're printing money, bro. And then plus you get fiscal policy too. You have the government printing money. That's easing the economy and the markets. And you have Janet Yellen, the U.S. Treasury, who has been talking about this summer. She said it last year that they might start buying U.S. Treasury. So again, that is quantitative easing, yield curve control, however you want to say it. Net. If we look net, there's more money coming into the market than leaving, and that's why the stock market is going higher, and that's why crypto is probably going to keep going higher. When do you think Fed will start cutting? You know what? I don't know a time. I don't know if I wouldn't say there's a time that the Fed cuts. What I want to see is inflation get below 3%. And I think they're going to think about it. If inflation gets below 3%, I think they start mentioning the cut sooner than later. If inflation collapses, they will cut. If inflation collapses, because you have another risk. If inflation collapses, it's also pretty hard. If inflation collapses fast, it's also a signal that growth might be collapsing. So they could cut rates. So I would say I want to see where headline CPI is at in GDP before the Fed cuts. Maybe they hold all the way till 2024. That's definitely a possibility. Maybe they don't cut at all. But for sure, it depends on where how fast inflation comes down. And I just personally think it comes down faster than most people do. So that is my view on that. I'm gonna pull up where's my trading window? I'm gonna pull up the markets for you traders, and on YouTube anyway, so you guys can see this. But yeah, I think the Fed when will the Fed start cutting? I think it really, like I said, if oil drops to the 50s or the 60s, and the ISM PMIs keep falling. Right now, they are falling. They're contracting. Then I think the Fed will think about cutting rates. And maybe, they might think about cutting rates. If we have another banking crisis, right? Let's say we have another surprise, they're going to cut rates. But also keep in mind that the market can move higher with elevated rates. It happened in 2017. Jerome Powell was hiking rates in 2017. I remember because I was invested in Facebook and I was like, what's going on? Why is the market tanking? And actually, no, not 2017. That was 2018. 2017 markets went higher while they raised rates because of fiscal liquidity, because Trump cut taxes, which is government spending. That's part of government spending. And we're still getting government spending right now. I think that's lifting the markets. We're starting to see that government spending coming back in the market. We've seen it for a while. CHIPS Act. And like if you were in NVIDIA, let's say you're an NVIDIA investor, you would be like, wow, this is a bull market, right? You would feel it. But if you missed it, you might still be scared. Oh my gosh, things are overdone. This can't be. Well, it's kind of a stock picker's market. it really depends what you're invested in, because that fiscal liquidity or government spending is going towards renewable energies or going towards chips and technology. And that's why I'm very bullish on tech going forward. Very bullish on tech going forward. What's going on here? These guys have nothing to say. Oh, Edward Yardeni. Okay. This guy has a really good, if you're on YouTube, I'm gonna play this in a second, right? I got the audio working now. Ed Yardeni has been calling for the rolling recession. Very smart dude. WIT jump, Saudi Arabia, Russia pledges output cut. Yeah, we'll see how that works out. Oil's going up a little bit. Anyways, we're gonna listen to that clip, and then we'll and this is a bull. This guy's a bull, right? He's bull. Am I biased? Yes, I'm a little biased. I'm more biased to the upside because I mean the setup is perfect. Technically, macroeconomically, and fundamentally, the setup is really good for asset prices to move higher. Not all assets, right? You got to pick you got to know which ones to pick, and that's where that's where things come in. But for the most part, we're going higher. Let me in the Discord. Oh, let me ask my my producer. No, I'm just kidding. Let me ask my business partner if it would work for us. We have a we'll have to figure that. We'll definitely, he's in there, he can hear. So you guys want to get in the Discord, we'll discuss that. Should we open up the Discord? We'll discuss that and see if it works for us. There's a couple reasons why. They will try to invade before Biden is out. Maybe. I don't think China, it's in their best interest to try to invade Taiwan. I don't think it's in their best interest because, there's a lot of people, more than anything, governments want a strong economy, right? And so if they invade Taiwan, they might mess up their own economy. There has to be it's a lot more complicated than just politics. It's economically, that's where you stick. That's why Biden has reversed and started increasing production for oil, because no matter what his politics are, if the economy falls apart, nothing matters, right? And so you need to get that oil price down, which is why he keeps draining the SPR. I'm a weed whacker myself. Lost another trade. What are you even trading, Broken Testicle? I'll throw it up there on the. I'll throw it up on the charts on here on YouTube. Yeah, what are you looking at, Broken Testicle? Slime, what up? What up, Slime? All right, yeah, so that's what we're looking at here. All right, so really quick, let's look at these levels. Look at the S&P is we're going to be I think we break out by the end of the week, because I expect the data to come in good. The data's been coming in so smooth. It kind of feels like the market is overbought and it needs to slow down. Maybe it does consolidate, but it feels like the market can't go higher. It needs to slow down, and it's really quiet, right? You don't really hear too much going on, but I think we're staging a wave 2 FOMO. That's what it feels like, because you're going to get labor. You're going to get labor data, job openings. Well, not job openings, but you're going to get average hourly earn. You're going to see that wage inflation is falling, and you're going to see. This is my view, by the way, my opinion. I think we see wage inflation fall, which is very bullish for the Fed to stop hiking rates, or to keep the pause, or to communicate that, hey, we don't need to be as tight as we thought we did. And also you get the unemployment rate remaining sticky. Hey, maybe it spikes. If it does spike, that's still bullish, because they're going to say, hey, we can't hike rates anymore. As a matter of fact, oh, there you go, Bukowski. If unemployment spikes above 4%, the Fed cuts. The Fed cuts rates if it spikes. That was another indication. It's not when, it's when you see this, if then, right? So if we get that, if inflation falls below 2.5%, the Fed cuts. If unemployment jumps above 4%, the Fed cuts. That's where I'm at. That's what I feel generally. Anyways, that's my general feeling about the markets. And we'll see if that happens. Maybe they just keep it at 5%, and that's okay, because they're still pumping liquidity, so they're still easing anyway. What do you think about AI tricking everyone that Gensler stepped down? Well, PM was this nighttime? PM. Hey, that's a stock, by the way. Here's what I think about this is deep fakes. So this narrative goes really deep here. Okay, this narrative goes really deep here. AI deep fakes are just getting started, right? The deep fakes in AI are just getting started. We're going to see a lot of deep fakes come into the market. And how do you solve deep fakes? Well, let's not get into that first. What do you do about it? How do you know? There's a lot of deep fakes that will continue to happen. just like any other technology. And the only answer is really blockchain. It comes down to blockchain because AI can't, it comes down to verification. So I think this is very bullish for the crypto industry, because it's all about transparency and security and verification. That is essentially the crypto ecosystem in general. Yes, is there a lot of fraud? Of course, but the blue chips, right? The blue chip stocks, or I'm sorry, the blue chip blockchains are not centralized, they're decentralized. And the idea is to have transparency and self-auditing ecosystems. And I think that's what solves these deep fakes. But either way, we're going to see a lot of pain. We're going to get more deep fakes coming into the market. And really, the people who are the crypto guys who are showing these deep fakes, man, it's like, bro, why are you showing deep fakes? You know that is AI generated. Why are you just trying to get likes on your channel? At least be honest and tell them, hey, this is a deep fake. I wouldn't use those deep fakes. I know exactly who did it. I'm not going to say his name, but we're seeing those deep fakes happen. And I think that continues to pick up. And I think it's bullish for the crypto narrative in general, because that's the only thing that can really constrain it other than more AI. Did you see Verge pumped something like 300% in 1 week? Verge, not sure what that is. It probably sounds like a crypto. Possibly it is a crypto. Anyways, yeah, let's take a look at some of these. Actually, yeah, we're evaluating the S&P where it's going, or kind of the technicals. Clearly, you can see that we're against resistance. Okay, once we get above this level, this could happen today. Like I said, after Powell comes out, we're going to see FOMO, wave 2 FOMO coming back in, and these things take a while. They take a while to happen. Now, maybe it doesn't. Maybe we come back and retest these lows at 441, 442. It's going to depend. Well, I'm sorry, Powell's not speaking. I keep misspeaking there. But the Fed minutes, right? When the Fed minutes come out, we'll see more consolidation. I don't really think we make a move. I don't think there's nothing that could be too bullish. It would have to be something he said that he fully reversed on, or the Fed said in general that they reversed on. I don't know if we're going to get that today. I think today's just a sideways market, and it's more of digesting what's going on. Are there potential trades? Yeah, there's some potential trades going on here. We do have some potential trades, and for that, I like to go to my screener and see who are the potential trades here. What do we got on deck? Oh, Rivian is pretty hot today, actually. See if there's any setups here. Any setups? Yeah, Rivian looks pretty. Oh, Rivian looks like it's starting to break the trend. Meta pulling in. Meta looks nice. Rivian and Meta have a couple patterns. Who is this? AZN. No, it's a drug manufacturer. So Meta here on the left-hand side, Meta, you could call that a bull flag, right? It had a sharp move to the upside. Maybe it bounces and moves higher. Also Rivian. Guess I don't even know what the ticker symbol is. There we go. Rivian, big gap up off of better than expected deliveries, holding PDC multiple times. 1, 2, 3, holding higher, starting to move up, breaking the downtrend. So Rivian, but it's still below VWAP either way. Not my best A+ setup. You could ride Rivian up. Always got to keep that trader mindset while you look at the markets. Not me, not you guys, but me. I always got to stay trading. I'm trying to do the macro, right? Handle and balance the macro and the trading at the same time. I like to do swing trades though. I like AMD. I like the setup on AMD, like I said before. And now it's starting to pull back. This is perfect. I want to see AMD pull back into this trend. So somewhere around 114 is where I'll add to my contract. And maybe it has to, yeah, because there's a gap here at 113.91. So I might have to fill that gap. It is a crypto. Did you yes, crypto XVG. I don't even look at those. So much noise. So much noise in crypto. And no, I have not seen that. But hey, if you made money in it, nice. If you made money, nice on crypto. Oh, I gotta get that clapping back. But do I trade? Will I trade cryptos, like day-to-day trade on crypto? No, I will not. Those are way too risky. Oh, here we go.
Nope.
Yeah, there we go. Yeah, I would definitely wouldn't do that for crypto. Crypto is volatile. It's basically call options. So you got to be careful. A lot of people lose money. They only show you their wins. Crypto is something you hold at the bottom of the cycle if you want to, make the best. If you want to get the best risk reward, you just hold crypto at the bottom of the cycle. How many screens do you have there? It's an old OG crypto. Oh, XVG's OG. What do they do? I don't even know what they do. I wonder what they do. Your resonance. How many screens do I have? Like trading screens, 1, 2, 3, 4, 5, 6. I've got like 6 trading screens, or at least 6 charts that I'm looking at. Definitely like AMD here though on this pullback. They did get upgraded today by some weird. Who is this? Benzi. Somebody upgraded them. I don't know who was who actually up, but they did get an upgrade, so that's good. So there's momentum. There's momentum sentiment coming in. You just want to see the pullback and the support for AMD. Anyways, I'm just keeping my eye on that. All right. I'm gonna switch the screen here on YouTube so that we can see what this guy has to say. Let me know how the actual sound is. We're gonna go over this. This is Ed Yardeni. He's been bullish for a while. He has a lot of good data on why the economy is stronger and it will remain strong. He has a lot of reasons why the economy will remain strong. Take off this banner. Report. Oh, you know what? I got to share the window. That's right. Because the sound doesn't work. Actually, no, I'll keep it like this. We'll just stay off the charts for now. We'll come back to it if it doesn't work.
The PMI. So I think
and sees a 75% chance of a so-called soft landing. Yardeni Research President Ed Yardeni joins us this morning.
So keep that in mind. 75. This is why he has a 75%. Or he believes there's a 75% chance that we get a soft landing. This is why right here. And I'll replay that. Can you show your screen setup? Can I show my screen setup? Well, give me a second. I'm not going to show it right now. Like I said, if you want to see my screens, jump on YouTube, and I'm showing those. But if you want to see the setup, then you'll have to wait a little bit. Okay, dang, the S&P is really starting to push that level also at the same time. All right.
And it's great to have you back. Hope you had a great fourth. You've been on fire lately, talking about rolling expansions instead of rolling recessions. Can you talk about how your views have evolved in the last, say, month or two?
Yeah, well, since early last year, we've been arguing that we are in a recession. It just happens to be a rolling recession, and it's hit housing, it's hit the goods sector. I think it's now going to roll into commercial real estate. But meanwhile, some of the depressed areas of the economy are starting to show like something like a bottom, and maybe even a recovery. We're seeing that in the housing industry as demand outstrips supply. We're starting to see, I think, a bottoming in the goods sector, in the manufacturing sector. Didn't see it in the PMI, but we're seeing it in the regional PMIs. So I think there's some evidence that consumers that had kind of pivoted away from goods to services may be looking for goods again, it's particularly automobiles, where the sales have been surprisingly strong. So it looks like the rolling recession is evolving into a rolling expansion.
This morning, you'd take a look at whether or not there are too many bulls, looking at the bull-bear ratio. And I've never seen this before, this notion that maybe the ratio we see now is not as bearish as the inverse is bullish. Is that right?
Yeah, that's correct. We did a study looking at the S&P 500 when the...
You know what? I'm going to switch it up so you guys can see the charts. I want to see how that looked, but we'll switch it so we can also see the charts at the same time. And I'll just have to play the audio out of a different backdrop. What up, Football Legends? I see you in there. So I gotta share the entire screen. There we go. Looks a little different, but this is exactly um how it usually looks. Let me see. Yeah, there we go. So this is Ed Yardeni. Can I zoom in? What about on this? No? Okay, cool. Yeah, that's Ed Yardeni, and he's basically saying, hey, that there's consumers have been switching to services, and the only goods that are starting to support the economy are the vehicles, new vehicle sales. So that's interesting. That's keeping growth up to some degree, and he calls for a rolling expansion. You can't hear nothing? Hmm. All right. No, nothing on YouTube. Interesting. Well, but before they could hear it out of the mic, because you could still hear me in the mic. He said he can hear it fine. Oh, that's on TikTok. Unless let's see, YouTubers, can you guys hear? All right, well, that was a flop. I guess you can't really you're not going to be able to hear on YouTube. So I'll just have to switch it up. And then we'll respond to this guy. Well, that stinks.
Trouble ever since the banking crisis hit. I think the Fed responded very well to that banking crisis by setting up a liquidity facility. You know, they got a lot of experience playing whack-a-mole back in 2008, 2009.
Okay, so he talked about the liquidity facility. That's what I talked about earlier, which is that even if the banking sector, because I know you guys are probably getting like, you guys are probably hearing that commercial real estate is the next big crisis. It's not a big crisis if everybody already knows it. The real crisis is that nobody can see it, and everybody can see this. They're already working on it. If something were to happen where commercial real estate did cause the banking sector to fall apart to some degree, well, the Fed's already created that liquidity facility that where, okay, let's say on their books they lost, they had to go insolvent because they lost. Well, that facility, they can go pull money from that facility. So either way, more Fed liquidity will be backing any type of weakness in the banking sector or the economy.
Creating liquidity facilities to avert a complete disaster. And so they moved very quickly with the bank liquidity facility, and it seems to have stabilized the situation pretty well. I am watching the weekly data on bank loans, and that's looking toppy in some areas, particularly commercial real estate, but it's not taking a dive. and the C&I loans are looking toppy, but that could be because inventories are finally back in control. Meanwhile, consumer credit's an all-time record high. So I'm not seeing that credit tightness that adds up to a credit crunch.
Ed, a lot of this stuff, when you throw it all together, maybe there is a kind of a slow growth or muddle through kind of economy that is supportive of risk assets for a while. You mentioned people are getting a bit more optimistic, but not yet necessarily at extremes. I wonder what you think it means, though, for expected equity returns. We're still on a 3-year basis. The S&P's given us 14% annualized already. It was even with that downturn last year. So it's been pretty good in recent years. I wonder what you think is left.
Well, I think from a valuation perspective, the market isn't cheap. When you look at the S&P 500 overall, you've got the mega cap 8 stocks now back at a 30 forward PE. But those have turned out to be almost bulletproof. I mean, they did take a dive, but that turned out to be an amazing buying opportunity in these 8 stocks that they've done extremely well. Meanwhile, you take the mega cap 8 out of the S&P 500, and you have a forward PE of about 16.5, which isn't cheap. It's a little bit above historical fair value of 15, but there's still plenty of opportunities, in my opinion, in some of the sectors such as infrastructure related, which would be the industrials. And I think the financials, there's still a lot of skepticism and concerns about the credit system, but I think it's going to hang in there pretty well. I think the financials are going to do fine.
Hey, finally, Ed, you've written a lot about inflationary pressures lightening up. We mentioned the ISM prices paid on Monday a few minutes ago. Do you think the next chapter is really going to be about inflation rolling off, especially given these base effects?
So again, he just mentioned the prices paid. Prices paid for the manufacturing side of the economy are falling. That takes away inflation, or that is a signal that inflation is coming down. You're not seeing it happen in business activity now. Let me see. Let me make sure that before he moves on, just so you guys know, we will get the next data point for services coming in. And this will come in, let me see, because we just got the manufacturing side on Monday or Tuesday. We get ISM services tomorrow. So tomorrow, exactly when I come live, when I go on live tomorrow, 10 a.m. Eastern time, we will get the ISM services PMI to find out if the service economy is decelerating, and then we'll reevaluate. And what do the prices paid look like? Are the services inflation coming down? And that will definitely influence the Fed to remain more dovish or less hawkish to some degree. And if those prices paid come in hot, though, then we're in trouble, right? We're not really in trouble, but it's 1 month-over-month signal. So we'll see where the trend ends up moving to.
Some of the bulls are counting on some pretty dramatic declines.
Yeah, I do, but I'm data dependent like the Fed, and I have to tell you, I wasn't all that pleased with what I saw last week in Friday's personal consumption expenditure deflator. I mean, the Fed's kind of looking at it the way we all are, and we've seen this tremendous disinflation in the goods consumer prices, but the services, as we all know, has been persistently high. It's been sticky, and we're not really saying that take a break here. I think what is going to bring services inflation down clearly is rent, and that's almost like a sure thing, to the extent that we know that currently inflation rates have come down dramatically, and CPI, the PCED, reflects that with a lag. So I think that's going to improve. But there's all these other kind of pesky services like personal care.
So again, the Fed, like, this is such a huge transition. Why I'm very bullish on the market, because talking about inflation, PCE, which is the Fed's preferred inflation gauge, it was a little sticky, but that stickiness is coming from shelter. And we all know, if you look at the real-time shelter, Redfin or Zillow or Case-Shiller price, home price index, or even the home price index data, all that inflation for housing is rolling over. It is collapsing really quick. So the Fed's inflation gauge, or their measurement of shelter, is very laggy. And I think that comes in this summer. And it's either going to hit on this print, which is, like, just so you guys know, if we're in July and we get an inflation report, that report is about the prior month. So it's really June that we're looking at. So I'm thinking either June or the June data or the July data, which could push us till August, where we see shelter or core really start to roll over, and at the same time you get oil start to roll over. You get the very bullish scenario. So keep that in mind, which is that a lot of the inflation pressures are coming from a very lagging shelter measurement that will eventually come in, lower. So we're expecting that too. It's just a very bullish macro. It's hard to argue that. And the market is right. The market is moving up higher because I think it's sniffing this out.
And veterinarians and things like that, where the inflation rate remains elevated. And I'd like to see some improvement there before I could kind of join the super bulls there and say, it's going to take a dive here. But I do think inflation is coming down to 3 to 4%. We're already below 4% on the PCED headline. I think we'll get down to 3% by year end.
Yeah, I mean, just to pick up on that thread, Ed, in terms of the pesky services side, how real is the risk of a wage price spiral here? You got UPS negotiations, which seem to be at least today publicly at a standstill. You have another number of other unions moving towards negotiations as well. So there does seem to be, amidst this still tight labor market, some potential upward momentum on wages.
Yeah, I mean, my contrary instincts are sort of coming out now because all of a sudden it seems that everybody agrees that maybe we're not going to have a recession after all, or at least that's gotten a lot of credibility. Only a few months ago, it was viewed as delusional to think that we weren't going to have a recession, and now I think there's a perception that, well, maybe the forecast of a recession is off base. But we're not out of the woods yet. There's still issues out there, and the market's had a great run. I'd like to see the market just kind of pause this summer, take the summer off, and then come back, that the rally comes back in the fall. But the market's not going to do anything that I want it to do. We could be in a melt-up situation in the mega cap 8 stocks and some of the tech stocks with the AI hype. But all in all, I think it's...
What a good analysis. That's the same thing I've said. I want to see things consolidate a little further. Well, first of all, he said people are delusional, or you thought it was delusional a couple months ago to believe that we wouldn't be in a recession, right? You hear, credit conditions are tightening. The yield curve is inverted. You hear that all. The yield curve is so inverted. Fed is hiking rates, all-time high rates, but they really don't know what that means. And either way, it was delusional to think the economy wouldn't collapse. And now everybody's like, well, maybe not, because we're seeing the labor market numbers come in. We're seeing housing start to bottom. Consumers are still strong. So now they're just forcing the recession. Hey, maybe we do. Like you said, there's still issues out there. But month to month, as we track them on this channel, right, on this live stream, we're not seeing that yet. This as soon as we get something negative or something that suggests that growth is going to roll over or collapse, then we will talk about that as this data comes in. Number two, the market, he said, has been very strong, and he's hoping this whole summer that we start to consolidate. But he's also acknowledging, because that would be healthier for the market to just run sideways for a while. It would be. We could see that. It would be healthier. Wow, Meta just had a pullback and now it's starting to break out. Either way, he said we could just have a melt up, which I think is a little more likely than a sideways. Like, we need more negative data. The reason I think we melt up is because I expect inflation to drop even further than him. If oil prices collapse, I expect that to happen. And if that is the case, then you get more FOMO, which I call wave two FOMO. We just had wave 1 FOMO. Here comes wave 2 FOMO. Could be set off by the Bitcoin ETF filing. If that gets approved, that's going to set more FOMO into the market. It's going to basically pour over everywhere. That's one part. Maybe it doesn't happen though. Okay, maybe we just move sideways. Either way, you also have the melt up from all the short positioning in the S&P 500. It's still squeezing higher. The Qs are already pressing the highs. So if we break out, it's just more shorts getting having to cover. Where did we get up to really quick? I'm looking on my charts here. I just want to. Okay, so the Qs they got up to 372 today. So 372.80 is the high. If we break that high, we just keep melting up higher. So he's making a good point. I really like this guy's research. I really like this. He called the bottom back in October. So let's just finish off his point and then we'll move on to the charts.
It's a bull market. I think it's a little overdue for some mini correction, maybe something like 5% this summer. And then I think we proceed to 4,600 on the S&P 500 by the end of the year.
We are watching all your commentary, Ed, pretty closely these days, as we always do. Thanks so much. Good to see you.
Thank you.
So a 5% pullback would take the S&P. We'll look at the charts now. A 5% pullback would take us, and I'm actually going to move over to the, no, I could stay on here. We'll stay on this one. We'll stay on the Thinkorswim platform. We'll keep on the, we'll stay on the Thinkorswim platform. What I'll do is I'll just highlight this window, maximize sell. There we go. Meta, I have Meta on the left. So he says he wants to see a 5% pullback. Where would that actually take us? If we look at the S&P 500, a 5% pullback from here. Wow, I have a lot of stuff drawn on here. And so we can get a little better visuals. I'm going to move to the, let's move to the macro charts. You can see the moving averages. All right, so a 5% pullback would take us, actually, let me go to SPX. I'm sorry, this is marked. I don't want to take off my trend lines because those are set for day trading. So 5% pullback would pull us into, from here anyway, would take us to, oh, perfectly. It would take us to 425. So that would be a new low. That would be a new low. That's a possibility. That is definitely a possibility. Not a new low, but the lower than the previous support. That's where it would take us 5%. For S&P 500, for some reason, I feel like NDX or the NASDAQ would be a little different because I just measured it. See, NASDAQ 5% pullback would take us to the to that last consolidation there. So we're still in a bull market on a 5% correction. It would get us closer to this 50-day moving average though. So it would be a little healthy, or we just get a melt up and we keep grinding up, you know, slowly. We just keep grinding higher and there is no pullback. Those are two scenarios that are a lot more likely than going back to the lows. I definitely don't see that happening. I don't know how that happens. Okay, Meta getting rejected at that level. Here we are. We're back to the charts. We are back to the charts, awaiting the FOMC minutes. I'm not going to be on here for the FOMC minutes, but yep, that's what we're looking at. What else are we missing? All right, let's take a look back at Tesla, see what we got going on here. What do we got cooking up? Intraday, so we do have Tesla finally starting to pull back. Yeah, look at that double top. Man, I've seen this pattern so many times. It's just forming a bigger wedge. My prediction is, because I've seen this so many times, my prediction is that Tesla had a nice gap up, and now I see the wedge starting to form with your support at 275, okay? 275 is support currently. It's the lowest support. I think we consolidate sideways for Tesla, and eventually we're going to drop. This happens all the time. We're going to drop 275, and it's going to look like all the people who get stopped out under 275, they're going to have to stop out, and they're going to be like, dang it, okay, well, I'll wait for a new low, and then it's going to capitulate right back up and then just make a new, and then break out finally. So you're getting the wedge start to form here on Tesla, right? You're getting the wedge form. If you're looking at this on the right-hand side, there we go. So you're getting that wedge form. Usually it'll form the wedge, and then it'll break down. It'll break down and flush out all the weakness and then just capitulate right back up. Is that the most likely scenario? I don't know, but it happens a lot. It's been happening lately too. It flushes lower. I know this chart's all marked up, but it'll flush lower. It'll make a new low and then just capitulate right back up, squeeze everybody up, because there's a lot of demand down there waiting to buy. They don't want to buy at the top. They just want to buy a little lower. So this thing might be forming for a couple of weeks. I hope it does. It just stays consolidating until we get the earnings. Earnings are coming out in like 2 weeks. So maybe 2 weeks we stayed. I don't know. 2 weeks is pretty long. I might try to make a move higher. So we'll see how long this does consolidate. Keeping your eye on the overall market, obviously, because the overall market is going to give us more insight to what's actually happening. Today, advanced decline. Oh, I got to get that on the advanced decline is negative. Okay, so we finally have the advanced decline negative also. I'm gonna pause this, see what else they got on CNBC, any other commentators, before we worrisome sentiment. Is this a bear? This lady might be a bear. Okay, we got some more commentary here. The Feds. Yeah, let's talk through this lady. Those of you who are listening, we're gonna talk through this. I'm not gonna show it here. I'm gonna keep the charts up, but I'm gonna let you hear it, and we'll talk through what she's actually saying. But first, let me take a small break. No charts on TikTok. Yeah, the charts will be on YouTube. I'll be right back, guys. And then we're going to go over this also. If you guys want to see anything, if you want to see a setup or some technical analysis, let me know. It'll be on YouTube. I'll do it on YouTube. So let me know if you want to see TA in the comments, whether you're on YouTube, whether you're on TikTok, and then I'll go ahead and do that. Until then, what up, Jason? Yeah, it's a lot better on YouTube. It's faster. There's no delays. Give me a second. I'm gonna go use the restroom, and I'll be right back. And then we're gonna do some TA if you guys want. And if you don't have any TA, I'm gonna go over this analyst who it sounds like is pretty neutral. It's a lady. It sounds like she's a little RBC Capital. It sounds like she's neutral on the market. We're gonna run sideways. There's too much risk. But the main thing is to hear the narratives and then kind of parse through where they could be right, where they could be wrong, or what data is supporting that historically, and where they're actually like, does that match your thesis? So we're gonna go over that when we come back. Small little break here, and I am gonna throw on the break. Here we go. Right back. All right, we are back. We are back. We got Meta selling off on bad news. No, I'm just kidding. All right, so we're gonna listen to this lady. I don't know if I don't know what her name is, but she has a S&P target year in. 4,200. And we're gonna see what she has. Yeah, thanks, Jason May. The YouTube looks a lot better. Of course, if you guys are over there on TikTok, come check out the YouTube. If you want to see the visuals, it looks a lot better than it is on TikTok. So I'm showing that. What up, big man's coming? I see you. I see you. But yeah, let's get into this. Let's see what this lady has to say while we keep the charts up here. Just FY 444 on the S&P is resistance. We're not getting above that, and probably until middle or the end of the. Actually, it could happen today. Could happen today. It's really starting to press up there, but we'll see. We'll see if it actually plays out. For you, yeah, for you guys on YouTube, I'm gonna make sure you guys can hear. Right, I want you to be able to hear, and we're gonna pause it, and then we'll go over like what is she talking about here? What is this lady talking about?
All year. And first of all, our target was 4,100 for most second session of the second half of the year, the third quarter. This month of July, the Dow is down by about 0.25%. S&P 500 basically unchanged. The Nasdaq holding on to just a 0.1% gain here. Of course, we had factory orders that undershot in May, showed a deceleration from April. And we're also looking ahead to FOMC minutes, which come out at 2. We'll have more on that in just a couple minutes.
Yeah, get a little color on that last meeting. Our next guest isn't quite bearish yet. However, her year-end target, 4250, warning of worrisome market sentiment, focusing on corporate confidence and the resiliency of margins going into an earnings season that'll give us some clues on how the rest of the year plays out. RBC's head of U.S. equity strategy, Lori Calvasina, is here with us on set. It's great to have you back, Lori. Welcome.
Thanks for having me.
You got to feel pretty good about the range you've given the year so far, right?
Yeah, so look, we've said all year, and first of all, our target was 4,100 for most of the year. We revised it up to 4,250, but we've said all along we could see upside to sort of that 4,600 mark, 4,400, somewhere in there. We have basically 3 models that are kind of cautious and 3 models that are really bullish, and 4,250 is right in the middle. I put out a piece a couple weeks ago saying, like, these are the top 5 charts that kept us constructive in the first half of the year. One of those is starting to get a little bit worrisome. It's not quite flashing red, but it's starting to flash yellow, and that's our sentiment model.
So describe that. What's your calculus in terms of how it may or may not move your model from here?
So it's the AAII net bull bear indicator. Everyone on Wall Street watches this, okay? There's a reason we all watch.
Oh my God, I already know what she's gonna say. I have a feeling I know what she's gonna say, and I just wanna front run this first so you can hear. I'm gonna show off here. No, I'm just kidding. But basically, I think this is the narrative, and I want to make sure so you guys know. Check me if I'm doing my research right. She's gonna say that the AAI sentiment indicator, which basically tracks sentiment for bulls and bears, it was extremely negative, and that's bullish for markets because if something capitulates or something comes out better than expected, people usually are investors capitulate back to the upside. So now that the AAII, it's the Bank of America sentiment indicator, is now extremely, well, it's not extremely bullish, but it's turning more bullish. So people are like, oh, okay, well, that's a bearish signal. Everybody's bullish, so we should be bearish, right? The issue with this is that it's where you're coming from that matters the most, right? It is where you're coming from. So if you're bullish coming out of the lows, that can remain bullish for a long time. That's good. That's a good signal that people are bullish headed from the lows. If you're already at the top, let's say S&P is like breaking new highs and month after month it's at new highs, everybody's extremely bullish and the macro backdrop's starting to turn down, that's when it's a bad signal. But coming out of a bear market, this is a great setup. It's not negative to have people more bullish. Why? Because there's $5.5 trillion of cash on the sidelines of margin debt, including margin debt. And people are like waiting, like the more bullish, the more FOMO, the more people start to buy in. So that's what my bet is, that she's going to say people are too, maybe I'm wrong, that people are a little too bullish now. And so they're waiting for that capitulation. Let's say she's right. Maybe there is a pullback. It doesn't matter. It's going to get bought up 2.5%. That's my guess, is that she's going to say the the bullish sentiment is negative for the market. Let's see what she says.
Watch it, and it's a very reliable indicator. You want to buy the market when you're at minus 10% or more in favor of the bears, and that's where we were to start the year, and that's really where we were after SVB. But recently, it's been hitting around 20% in favor of the bulls. Now, when you start to hit 30% in favor of the bulls on a 4-week average, you basically get a flat market over the next 12 months, and it's 50-50 as to whether or not you're going to be up or down. So the fact that all these investors I talk with are kind of begrudgingly getting pulled on board with this rally, I wouldn't say they're bullish, but they're losing their bearishness. That's taking away one of our good signals. Other models are still constructive, though.
They're losing their bearishness finally. I mean, after a rip-roaring first half of the year, I imagine the most.
Okay, so she's not saying super bearish. She's saying flat. So the fact that everybody's bullish, the market remains flat, which is fair. Fair enough.
Them are underwater. I mean, how much of this sort of pressure factors in? Because you have a whole other host of investors who may have called this perfectly and are saying, you know what, this gain for the year, I'm done.
So it's interesting. I talked to one person I know that was caught kind of flat-footed by this move in the first half of the year. I talked to him a couple weeks ago, and he said, we're going to have to start going to all these meetings soon, talking about our second quarter performance, and it's not going to be fun. Just, really dreading it. And I think there are a lot of conversations like that that are starting to happen around Wall Street. Why did you miss it? And a lot of my conversations with investors have been, this market's been resilient. Why? Explain it to me, because they're having to get ready to go out and answer those questions to their clients. So I think it's tough.
So what do you tell them at this point?
Oh my God, that is perfectly true. That's exactly true. What I think, this is why I think we get wave 2 FOMO, because a lot of fund managers, or you at least get a buy, like you're gonna get a bounce. Like every pullback is gonna get bought up, because these fund managers who've missed out on the rally, who were bearish on tech, and you've seen them on my TikTok videos, even on the YouTube channel, they're bullish on tech. They have to explain, well, why were you wrong? Why were you wrong? And why are we not in NVIDIA? Why do we not have Tesla, given the supercharger network, the possible FSD release this year? Why are we not bullish on AMD and NVIDIA for the chips, right? Why are we not bullish on Apple with their new product coming out? Why are we not bullish on Amazon with their AI? Why are we not exposed or overweight to generative AI? Why are we underweight risk assets? Why don't we have a piece of crypto, of Bitcoin, if BlackRock's ETF is coming online? So they have to answer those questions. And overall, they're going to get pressured, because they're managing other people's money, to end up buying each pullback. And that's why I think we just keep melting higher. I think the probability is in that favor. We haven't even talked about the macro. What about inflation dropping? What about the Fed pausing? It's happening now. Inflation is dropping. I expect it to be at 3%, while the Fed is on pause, and the rate hiking cycle is starting to turn down. So I just wanted to mention that as she speaks. I want to see if she says it. She hasn't said it yet. They can't say what they really think.
I mean, you can say the sentiment indicator indicates this, but yet you have a lot of other points in your note indicating that companies are better off, that management teams may be better equipped to handle crisis, that cash in the balance sheet is good, debt is there, but it's long-term debt. So how do you weigh these factors?
So basically what I tell people is this market is not crazy. It's been quite rational. We're here for good reasons. Some of those reasons are still intact. Some of those reasons are starting to break down. It feels to me like we're a little bit murkier tactically. But I've also told people, look, if we end up at 4,600 at the end of the year, that's the tip top of our bull case. We're not going to sit here and say this market was crazy in the second half. I'm going to say, shame on me. I should have paid more attention to my more constructive models. That's our valuation and earnings model, by the way. And we've told people, we have to watch the sentiment indicator very closely. If I say talk to a client, once a quarter, right, and I'm talking to them now, it's probably going to flip to the red by the time we talk again. Now, we'll have to see where everything else is. But I think you just have to take it day by day, week by week. And I think you have to look at sector opportunities, right? So we talk a lot about healthcare right now. There's not a lot macro going on in healthcare. It's cheap, improving earnings revision trends. A softening labor backdrop is good. If we get a little bit of an air pocket, it's going to help you out. Even if we don't get that air pocket, it still looks interesting. So we're trying to help people identify those kinds of opportunities.
I'm trying to think of ideas that really developed in the first half. Housing, infrastructure, AI, Japan. Do you see new ideas developing in the second half, or are we just going to build on the ones that we've already got in motion?
I think we're going to continue to build on them. And I'll tell you on the AI point, I really fight with people on this. And you guys know me. I'm not really a big thematic person, right? I'm facts, figures, layers, geographies, sectors. But the AI theme, there's a misperception, right? There's this view that AI dominated the entire first half. You have to differentiate between the AI related stocks and AI as a theme driving the market. If you look at transcript activity, AI really only burst on the scene in May and June. It wasn't driving stocks back in June. It was anticipation of Fed interest rate cuts that was driving tech stocks back in June. So we've told people, yes, maybe some of those stocks are a little extended, look elsewhere within tech, but the AI theme still seems very early. And there's a paucity of secular growth stories.
That is true. The AI theme is very early. So those people that say AI is in a bubble, it's like, bro, the AI theme barely started playing out in May, June, really, and we're in a bubble already. Like bubbles take years to really play out. So I don't think, by the way, look at Meta. If you're trading, I'm not saying go buy Meta, but Meta looks like it's really trying to support VWAP and move higher. And you are getting the support on the Qs currently to retest. Might be a small scalp back to the highs. Anyway, yeah, the AI theme is barely starting to play itself out. And investors were expecting, she said, rate cuts, but I think the pause is enough. That's pretty much a pivot in my view, because the rate of change is changing. Your expectations are like, okay, we're slowing down now, right? We're not full speed ahead right into a wall. Now we're starting to slow. My anxiety comes down. I want to be bullish on stocks. I want to front run the market a little bit. I'm not fully in. That's why cash is on the sideline. So yeah, I agree with that.
Stories out there. We talk a lot about the shape of the recovery next year, what that looks like. Right now, consensus estimates are for a little under 1% on real GDP next year. Well, guess what? Growth stocks do well when economic growth is sluggish. That is why everyone's fascinated with AI right now. It's one of the few secular growth themes out there.
And why is that? When growth is sluggish, that's why I'm so bullish on tech, looking at technology and software, because when the economy is slow, okay, the infrastructure, housing, whatever, when the economy is slow, stuff like Netflix, they still got to bid. They could still grow their margins, because what they do is they cost cut. They cut a lot of employees, their software engineers. They can get rid of a lot of engineers. Meta, Apple, I don't know about Apple, but Amazon, Google, whoever, they can cut engineers, tech in general. So they save on their margins, they increase their margins. And then when they implement AI into their business, the expectation of that is, well, now you can produce more at a lower cost. And that they can beat revenue, right? They can increase their growth rates regardless of a slow economy. So risk assets actually do better, counter to what people say. They actually do better when things are slow, because they can actually grow their earnings, versus like if you're Walmart, maybe Walmart's not the best example. Maybe like, who would be a high end, maybe Target. Maybe people stop shopping at Target, or I don't know if that's a great example, because it's kind of a bellwether, but let's call like an expensive a store. What would it be? Maybe Ulta, like a makeup industry, right? Even though that's not a good example either, because people still buy those services. But think of a store where if you have less money, you're buying less at that store. But versus your Netflix subscription, you're still gonna buy that, right? You're still gonna pay for Netflix. They literally cut off password sharing, and the stock went higher, because people are still gonna buy $14 a month. They're still gonna pay for the Netflix, or $8 a month, whatever it is. So technology still performs in a slow growth environment. So either way, tech like wins no matter what. And if growth slows too much, rates come lower, or we're getting the pause, and that's another bit on tech.
Reshoring is another. That's why industrials are so expensive. We're telling people you may not want to be overweight industrials right now, but certainly don't go underweight, and don't sell out of them right now just because they're pricey.
Putting on your old tech hat from years ago, right?
Yeah.
It's a good time to have those bona fides.
I know.
Lori, thanks. Good to see you.
Thanks for having me.
Calvasina.
Let's get to Washington. The Fed releasing the minutes from its June meeting this afternoon. CNBC senior economics reporter Steve Leisman joins us now from D.C. Hey, Steve.
Hey, Melissa. Yeah, markets hoping the Fed minutes can shed some light on a decision at the last meeting not to hike, but the forecast for 2 more hikes that were in the Summary of Economic Projections. And they're bracing for a jobs report coming Friday that they keep believing is going to show some slowing eventually, but keeps defying expectations. Here are the probabilities. Futures markets almost fully priced in a 25 basis point hike for July with an 83% probability. Traders have raised the chance of a second hike It's around 38% now, but still below 50. So still some skepticism out there. 2/3 of the FOMC members forecast that second hike, and it's one hike or more. And it's hoped that the minutes can provide some clarity on just how hell bent they are, or if there's a sense they can be dissuaded by something like slowing payroll growth. That's the forecast once again as economists.
Okay, cool. So basically, the Fed minutes, again, as we talked about earlier, are going to give some clarity to whether the Fed have changed their stance on hiking rates. There's an expectation that they hike two more times, but the market only believes that they hike one more time in July, which will be in a couple of weeks. And or maybe it's next week, could be next week, that they hike rates and then they pause, they hold the pause, because you're still getting a deceleration in growth, as we've talked about. Is it hitting better than expected? Yes, but the deceleration is still happening. So we'll get the non-farm payroll data coming out, I believe, this week. Yeah, Friday, which is payrolls. That's why it's going to be so important. So it's really a good thing if we see payroll still decelerating in the trend, right? Because that, for the stock market to go higher, because that's going to force the Fed, at least put pressure on the Fed to pause, maybe not even hike, or maybe take off the second hike expectation. But we're still not in negative territory. Payrolls are still pretty strong. People are continuing to spend. So it's tight. It's really confusing. I know, I get it. It's very confusing. And that's why we track this on a weekly basis. But for the most part, you want growth. I always say this, you want growth to slow, but not collapse. And that's exactly what we're seeing. Slower growth, but not in negative territory, not contracting. All right, let's get past this a little bit. Let's see if there's another. Chinese markets are poised for a breakout for Beijing stimulus. Hey, that's another big thing too. Is that China is poised to continue stimulating because their economy is not recovering as fast as we thought it would. And whoa, what is this? Yeah, so we're not seeing that recover as fast as. Oh, this guy is key. Oh, I like this guy. He's from Renaissance Capital. He does technicals in the bull market. I mean, he does technicals on the market in general, and that's where I got the triple B spreads indicator. Market's very slow right now too. We're getting a very slow market, not super fast. Let's see. Shout out for the subscription. Thank you for subscribing. Let's get that shout out here. Thank you, Watermelon. Appreciate the support. Yeah, if you guys think I bring you value, you can ask questions. I'll answer your questions. Subscribe, help me out a little bit. And okay, so yeah, I want to hear what this guy says. There's a lot of commentary. Like I said, a lot of this is driven by sentiment. So let's see what he says. I'll give you my opinion. And of course, I'm bullish. I'm biased to the bull side, but I want to interpret this because a lot of these guys or people that come on CNBC, they speak very technical, so it's hard to interpret it. So I'm going to interpret it for you guys the best I can. So the last lady who was on here, I don't know her name. Sorry, I called her a lady. I don't know her name, but she basically said that, hey, we're kind of in neutral zone. We really don't know. Should we get overweight stocks or should we stay a little more neutral? We're not sure. We have a bearish model, a bullish model, and it's basically telling us that maybe we just move sideways for a while and then we move higher. I think it's just really tough for people to admit or to concede that they were wrong and that they should get in because they're afraid that, okay, as soon as we start piling in, the market's going to pull back. So they want to see more data. And that's fair enough. Maybe we will get more data coming into the market, but what are you going to do? What are you going to do? She's basically mentioning that the AI narrative is just starting. So it's extremely deflationary and you're going to get inflation decelerate on the next couple prints further. All right, let's hear what this guy has to say. This is Renaissance Capital. I'm not sure what his name is.
About to enter a recession. Joining us now, Renaissance Macro Research Chairman and Head of Technical Research, Jeff DeGraff. Jeff, great to see you.
Thanks.
You've actually been in the bullish camp since November of last year, which I'm sure was a difficult position to take, but you're looking good right now. So you're saying that things still look pretty constructive at this point going into the second half?
Yeah, Melissa, I think we're in pretty good shape. The trends are good. The momentum started to pick up a little bit. We're seeing an improvement in breadth. All those things are important and should be able to propel the S&P to 4,600. I will say I'm a little concerned here recently with the rise in the 10-year yield. If we get that above 4%, I do think that starts to challenge the S&P in terms of alternate cash flows and returns.
So real quick, what does he mean by that? I expected the 10-year yield. First of all, the 10-year yield is the cost of capital from the bond market, right? And the reason that's important, and we always go over that, is obviously the higher it costs to borrow, the more expensive it is to fund your growth. And that puts a pressure on the market. When we talk about rates going higher, that's really what we're talking about. Not just the Fed funds rate. That is only a 24-hour rate for the banking sector. The Fed funds rate does not set the rate or the cost of capital or the interest rate for the actual stock market. The bond market sets the cost of capital for the stock market. So 10-year yields, which again, we always talk about all the time, those are the benchmark rate. You have a bunch of yields from 3-month all the way to 30-year, but the 10 years, the benchmark rate. And if that gets back above 4%, it's going to push pressure on the stock market because it's basically saying, hey, we're raising the cost of capital for you. And that's a negative for the market. So that could cause some downside. And also when yields go higher, we also see the dollar seems to follow. And that's going to basically, so that's, I didn't even think about that. That could push us lower. That could keep us sideways or push us back to that 5% retracement if we see bond yields break out. I just really doubt it because I expect the labor market data, because what pushes bond yields higher in general to the cost of capital is higher inflation and higher growth. But growth is decelerating and so is inflation. So it's kind of weird. Why are bond yields moving higher if inflation's coming down and if growth is coming down just because expectations are getting beat? That's why. So I don't think it lasts. Maybe I'm wrong. Maybe bond yields do go up, but it's basically the cost of capital, interest rates for borrowing money in the stock market in general. And if that goes up, then it's going to put pressure on the downside. Now, the bull case is that we get yield curve control. Okay, that's the bull case. What that means is the U.S. Treasury, Janet Yellen has talked about this. The U.S. Treasury comes in and starts buying bonds. And if they come and start buying bonds, they're essentially pushing the yields lower. That's exactly what happens when you have more demand than supply. Yields go lower, the cost of capital goes lower, stocks go higher. So that's the bull case. I don't know if he's going to talk about that. The bear case is yields keep going up and puts pressure on the stock market. And so that, yeah, we'll see how it plays out.
That's one area of concern. And then the other is just what we're seeing from seasonality. Historically, the end of this month is kind of the peak for the bullishness from a seasonal perspective. And that then enters into that late third quarter where seasonality tends to be the roughest. So I think we've got a decent little patch here to continue the gains, but we have to keep an eye on those yields because I think that's a potential impediment to the S&P.
How does that yield chart look in and of itself, Jeff?
I mean, if I just take a step back and look at yields from a technical perspective, it looks like they're going higher. So I do have to be mindful and respectful of that. But, is it a disaster? Is it 5% or 6% or, some of the big numbers that are out there? I don't think so. I think it's probably somewhere around 425. But at that level, some of the work that we've done with our yield impact model, et cetera, does start to push against the S&P. So that would be some concern for us.
Yeah, 3.9 this morning is going to take out the June highs. Jeff, some of your RenMax tweets have suggested that the bears are going to need to start pivoting to some degree. What do you think they are thinking as? Okay,
so to finish up on bond yields. Okay, to finish up on bond yields, they are starting to break out. The bond yields are starting to break from a very bullish flag pattern, but it's really the lack. Forget the yields. People don't trade yields. Essentially, they're trading the bond market, and the bond market is falling lower. I actually forgot what I was going to say about the yields. I totally forgot. We'll just go into this. Right, let me hit the button real quick. Stupid. All right, we'll keep going.
As we go into the second half, and do you sort of suspect that we'll see some towel throwing?
Yeah, I mean, we've seen it a little bit, not not in mass, but certainly it's been pretty hard. Once you got through 4,200 in terms of levels for the S&P, it was pretty hard to justify the bearish positioning. I know there's an earnings story out there, et cetera, and there's some concern there. But that chart that you had up earlier, I think, is important, which is healthcare. The relative performance of healthcare is very close to making a new relative strength low. That's not something you'd expect to see going into recession. You'd expect it to start making a relative strength high. Over the holiday, we saw that consumer discretionary relative strength actually made a confirming high. So those are pretty atypical of going into recession. And I think the recession bears that are out there have continually had to push that call back. And we think it probably has to be pushed back for at least the remainder of 2023.
Jeff, what's the risk reward at this point? I mean, seeing that yields are a stone's throw away from 4%, and that's sort of the level that could provide some resistance for the S&P 500. What is the upside that you see if we remain on the 10-year yield below 4? And what's the downside if we go above?
Yeah, that's a great question, Melissa. So 4,600 is the upside in our view, and that's if we keep yields below that 4% range. If we start breaking above that, obviously it has an impact on how far those yields go. But if it's within kind of our guesswork, which is a peak right around 450, then you're talking about 4,200 on the S&P. If we start getting below those numbers, then we start to chip away at the identification of that uptrend, and so that would become a problem for us. But I do think we'll pull back. I think that there is a risk to that, but it's still within the context of an uptrend, and that's an important precondition.
Are you spending a lot of time thinking about the inflationary dilemma that Europe is in, and is that contagious?
All right, so there's the 10-year yield. You can see it's at 3.89%. Okay, yields are interest rates. The higher they go, right, relative to the market, the higher they go on a more macro scale, not just day to day, the more pressure on the downside. Now, I remember what I was going to say. What I was going to say is this all really depends on inflation. Okay, we just haven't got the print yet. Here it is. The reason why yields have been climbing is because the Fed is raising their expectation to hike rates for 2 more times, right? July and August. So even though the stock market can still move up, and it has been with those hikes in place, the expectation, bond yields are basically saying, well, shoot, they're beneath the Fed's they're at 3.89. The Fed's at 5.25. So the more that they hike rates, the more that kind of influences bonds also, our bond yield. This is very confusing. Point being, as long as the Fed hikes, it pushes yields up. Okay, so let's say Jerome Powell comes in and says, you know what, inflation is pretty tame. We're gonna hold here. We're gonna pause. That puts pressure on the yields, on the bond yields to go lower. Number 2, I think this is the biggest factor. If inflation CPI comes out extremely low, below expectations, people will stop. The bond yields will start to fall again, right? They'll start to fall again. So that should actually happen. I don't know if it really happens, because there's also another scenario, and I'm not just like super biased here. The other scenarios, bond yields just stay elevated because nobody's buying bonds, because they're like, well, shoot, if inflation is down, why would I buy bonds? Because the economy is recovering. So we only buy bonds when the economy collapses because growth is collapsing. But if growth is not collapsing, inflation is coming down, I'm better off buying stocks. So really that capital flows from the bond market or potential bond market to the stock market. And if that is the case, maybe we do have higher yields. Maybe I'm wrong. Maybe we keep higher yields for a while. And then the next question is, well, the US government can't deal with these high yields. They have to pay the interest on those yields. That's literally the US Treasury. They have to pay the interest, which means that, the only way to keep this sustained move over time is if somebody comes in and buys bonds. And I think that's going to be the federal government or the US Treasury. The Fed or the US Treasury at some point. I don't know. We'll see. I know it's kind of nerdy talk and it's a little confusing, but again, maybe some people appreciate it. And you just got to know, you really want to know this stuff. You really want to ask questions if you have questions, but you really want to know this stuff. Even if it's boring, you should probably know it so you can make better decisions going forward as an investor or as a trader. You want to know what it means.
I don't think so. Look, we listen to the charts. We watch what's happening in the marketplace. I think China is actually going to end up being a huge help in terms of the inflation data. The work that we do actually has inflation in a pretty decent zone. We use a lot of diffusion type of indications, and the market cares about better or worse, not good or bad. And so as long as that trajectory, which is apparent here in the States anyway, continues to be better, and that's what it's been really since this time last year. It's been better. It hasn't been good, but it's been better. That's been helpful. And I think that's going to be a big part of.
Hey, that is so big. There's a couple of people who said, well, inflation is still elevated. It's bad. The market, it's hurting. The stock market doesn't care. The stock market only cares about the rate of change, or if inflation is improving or if it's not improving. It doesn't care about the absolute level of inflation. It cares that inflation peaked last year in June and it's been coming down for a whole year. And that speaks to why we bottomed and we're up 27% in the S&P and the NASDAQ, right? Over 25%, because it's making progress. So as long as we keep making progress, which we will see, like I'm betting 99, I have a 95% confidence rate that this next print, obviously, because it is the base effects of June, last June was the highest inflation print. So this should be the lowest inflation print, or this should push inflation a lot lower because it's a year over year reading. So once we get that, speak to you. Okay. Anyways, inflation should drop. So I think the market's going to be very bullish. You could see that on the S&P, we can't get above this 4,400 level, and maybe we don't for even the labor market data. But when that inflation comes out much lower than actually, we gotta check expectations, because I want to see how much it's going to take. But anyways, I just wanted to highlight really quick that the market, the stock market, cares about the rate of change of inflation, not, oh, it's at 5, it's at 4. It just wants to see progress, making it come lower. Because bro, you can't just say inflation is so hot at 9% because it's above the 2% target, and then inflation drops all the way to 4 and you're still saying inflation is so hot. Bro, no, it's cooling. It is literally cooling. The trend is lower. The rate of inflation trend is lower, and it continues to point lower. So that's the point. Stock market just wants to see that.
Of what we end up seeing. If it ceases to get better, then I think we could have a problem. But I don't think that that's the case. We're in a pretty decent zone in terms of that data, and more importantly to us, the way the market's responding to that. And I think that's going to be important as we go forward. If we see energy relative performance or material relative performance start to pick up, I think we have something to worry about, particularly with those yields if they're above 4%. But at this point, we're still keeping the powder dry.
Got it. Jeff, thanks. Jeff DeGraff, Renaissance Macro. Let's get back to Phil LeBeau with the GM numbers. Phil?
Let's all right, so the market is expecting a 3.6. We're at 4% headline, okay? The market's expecting 3.6% inflation. I think that's a really good setup. That's literally a drop of 0.4, right? It's a from 4% to 3.6. And keep in mind the last expectation, or not the expectation, the last drop in inflation was a whole percentage point. With oil this low and with shelter prices coming down, I think it's very possible we hit low 3s and we hit better. This is a setup for better than expected inflation. Maybe I'm wrong. Maybe somebody can point out where I'm wrong, but I think we hit lower than expected inflation. And that progress launches us into wave 2 FOMO, like I've been saying.
Let's try this again. We knew that the sales would be strong in June.
I don't care about GM, bro. Who's trading GM? Nobody cares. So those are a couple of market analysts when it comes to the macro backdrop, what they're seeing. Now you guys got that. So we can flip back to the charts. I just wanted to see, is there anything else? These guys talking. What are they talking about? They always have a pretty good discussion here. Oh, they are talking straight market talk. Okay, well, maybe they have something good to say. Let's do some Q&A though. If you guys have Q&A, we'll do a Q&A, answer some of the questions. I don't know who Joey is. Leon Forrest. I have no clue who Joey. I don't even. Are you sure you're talking to the right person here? I don't know. I don't know who that person is. Not sure. you know what? We're doing market commentary. We might as well just stick with it for now. Seems like you guys kind of like this, right? You want to hear what people have to say. We are over here on YouTube. We're live on YouTube, so you can hear the feedback. I'm gonna, yeah, let's see what these guys have to say. We'll just stick with it for now. This is all headed into the Fed minutes, by the way.
3%. Joe, you're right here. What do you make of this on the first full trading day of the year? To see volatility spike up, a very different story than we saw in the first half of the year.
Look, two very strong quarters consecutively to begin the year. You can't dismiss the premise that at some point you are going to have a correction for the markets. How deep is the correction going to be? I think it's going to be very shallow in its nature. And I believe, barring a geopolitical shock, 2023 will be a very strong year for equities. But the catalyst for the type of correction that I'm speaking towards, I think it comes in the Treasury market. I think it comes with a 10-year Treasury getting back above 4%, a 2-year Treasury getting back towards the March highs at 5%. That would be the area of the market that I'm focused on. I think the news this morning regarding weakness in the Chinese economy, in particular for the services industry, that's more about the commodity story. And I think that's more evidence why you want to ensure that your portfolio has the exposure to mega caps and to technology, because it seems to me until China is able to really reopen with strength and contribute to global economic growth, that commodity story is going to be under pressure, whether it's agriculture, oil, or steel.
All right, so he's looking at just basically that picture right now. Jenny, I'm talking to you now. We're seeing volatility up just a bit. We also talked about this rally.
So he mentioned China, okay? And that's very important. Like I said before, the Chinese economy is not recovering as fast as they thought. And they use oil, right? Obviously, oil is one of those big commodities. Well, if commodities don't catch a bid, that's basically going to push inflation pressures even lower. Inflation's going lower, okay? That's why you see OPEC cutting production again, because there's not enough demand, guys. There's just not enough demand for oil right now. It will pick up eventually. It's going to pick up. But for now, those oil prices collapse, and being the biggest input to inflation brings inflation lower. So yes, Chinese economy is weak, and this is why this is bullish. Number one, demand goes lower, inflation gets pushed lower. Number two, the only answer to slower growth economically is more stimulus. So we should get more stimulus from the Chinese economy. That will go into multinational. So basically, let's say you give more stimulus into your economy. Well, those people who want to buy a Tesla, Tesla earnings go higher, or an iPhone earnings go higher, because there's more demand for those products now in the hands of the consumers or the businesses or whoever it is. Number two, crypto assets, right? Crypto assets are not US assets. This is a worldwide global asset class for anybody. And you better believe that China, that Chinese consumers are going to own crypto assets. Some of the biggest mining rigs for Bitcoin are there. So that global liquidity picking up turns M2, money growth up. So very bullish that China is weak right now, because it knocks down inflation, and then it also increases more cowbell, more stimulus.
Broadening out a bit, but again, on the first full trading day of the year, it's the small caps that are getting hit.
Yeah.
Oh, I see what's going on here. We actually have some bots. We have some bots in the channel. I don't have it. Just so you guys know, I never opened up any Discord. So if anybody's trying to get you to go to their Discord, that is not me.
Well, it's the whole 6 months ahead, right? We've got 6 months under our belt, 6 months ahead. And one of the things that you and I were talking about before the show started, Frank, was the unbelievable divergence and bifurcation in returns. Right. So I think, a day or two here doesn't make a market, but it's pretty wild thinking about what happened in the first quarter, how the NASDAQ was up 31%, S&P was up 17%, the Russell equal weighted index was only up 5%. So when Joe said there's a high likelihood for a correction on equities, I think that correction could be as bifurcated and as divergent as the rally was in the first half. So looking at this and thinking about small caps, it's just stunning. I mean, here's another thing that
in the upcoming quarter.
In the upcoming quarter or second half. I mean, it could be the whole second half.
Statistically, it's more likely that you're going to get the correction in calendar quarter 3.
Okay.
Actually, calendar quarter
right.
4 is historically a very strong quarter.
You're right, because everyone's gone in the summer and volumes dry up, and but on the small cap thing, it's so shocking to me. So I'm looking at current valuations versus 20-year averages. Small cap value is trading at 90% of their 20-year average PE. Large cap growth is trading at 144%. So I don't really worry about small cap today. I just look at that and think, holy smokes, it's undervalued.
I want to jump off something Jenny just mentioned, the S&P equal weight. Savita Subramanian of B of A coming out with a note saying in part, we expect the breadth to continue to broaden out as seen in June. And she expects the equal weighted index to outperform the cap weighted index in the second half, very early in the second half. Obviously, today we're not seeing that just yet. But do you believe we're going to see the market continue to broaden out, Steve?
You know, we could. It's natural because you've had, you know, those narrow set of stocks that have done so well. So then you've got to see some catch up from the others. You know, I think what's interesting today is that it's, you know, when you talk about small caps have had a great run lately. So it's not unusual for them to give up some ground, particularly.
This guy is a bear, by the way. He's been short for a while.
This being a holiday shortened week, actually, some say a holiday week. So liquidity is just not there, and they generally are less liquid. So I think that explains that. Like Jenny, you can't draw a trend from one day. I think, though, more are looking for a correction. And now that they've got such a great first half, that if you play the right stocks, that's equal to a couple of years' performance. And it's very unusual, as you know, for stocks to have that kind of performance when you've seen rates move up as they have. So I think people are getting more nervous about the market. To Joe's point, look for that correction this quarter. But you're lapping some pretty aggressive inflation numbers. So you should see inflation indicators start to moderate, particularly rents, labor. I don't know if you will. I mean, take a look at UPS today and the strength of the unions and of the labor force. They're still able to command pretty good wages. So overall, yeah, it should broaden because that's just natural, you know, way things
All right,
go.
really quick. Look, too much coffee. I'll be right back. Too much coffee. I'll be right back. Stay with us. I'll throw on the commercial break really quick. All right, cool. We're back. We are back. Yeah, we got a lot of Al bots in there. That's hilarious. People really do bots in a live stream. Live bots in a live stream. Wow. All right, so this guy's bearish. Want to get the sentiment on the table. What is Wall Street? I know people always say Wall Street, but these guys disagree with each other. This guy's been bearish all year. Sounds like he's sort of changing his tune to some degree. All right, let's hear what he has to say.
When you see markets move up. But I'm like Joe, I'm a little cautious
All
on
right,
the correction.
So Wes, you're saying it makes sense for it to broaden. Jim, I'm going to toss this over to you. Another note from B of A saying that they saw the biggest weekly inflows since October, and it really was focused on communication services, record weekly inflow. One of the names in that index, Meta, hit a 52-week high today. So even when we see a quote-unquote broadening out, it's still mega cap tech, that AI trade pushing things higher.
Yeah, a couple of thoughts here. First off, it is a short week. This seems like a light trading day right now. It feels a little bit like Monday. Frankly, the equal weight was underperforming this morning, and now it's kind of caught right back up. I think this is a market that is still on the edge of, are we going to have a recession or not? I'm of the opinion, by the way, I've been consistent on this, that at this point, it doesn't matter whether we have a recession. The market's looking forward to 2024. But in honor of my nemesis to the right here, who is so fixated on a recession, I think I'll play this game and just say, okay, look, if you have the recession, the market's not going to broaden. The top-down macroeconomists are going to be right. By the way, they've been taking their S&P 500 estimates consistently down, their earnings estimates consistently down all year. On the other hand, stock-specific people like me, like Jenny, we really focus in on what stocks are doing, what companies are saying. We see estimates going up. We see guidance going up. We see enthusiasm from managements. And that disconnect between the top down and the bottom up, guys, has to be resolved. Good news. It's going to be resolved soon. There's a bunch of things coming up in the next week and a half. Right. You got the labor report. You got CPI next week. That's a big one. That's a big one as far as what the Fed will do. But even more important, earnings coming up. Jenny, I know you love this. You want to live there. Earnings start next week. You get Delta, you get the banks. And we're going to get a resolution as to who's right. The top-down guys, the bears, like my good buddy here, or the guys who are looking at the stocks, the guys and gals who are looking at the stocks and see pretty good things.
That's sort of a mischaracterization. Right?
Yeah, this is a great macro setup for the bulls because you have, like I said, the labor data coming out on Friday. Then you got inflation the next week, and then you get earnings beginning again. So we'll see if the earnings revisions to the downside are actually happening. And that's going to be big. Last time we talked about earnings, that was a huge catalyst. That's when we started to see Apple break out. We really started to see big tech break out over the last earnings. And now people are expecting this quarter to be the last negative earnings. That is the expectation. And I think stocks can really get bullish because they're sniffing out the end of the earnings recession, right? And if inflation comes down, the more it comes down, the better it helps earnings also, because you're taking away that interest rate cut on your earnings from inflation if you're on the supply side. Now, if you're passing that inflation on to consumers, yeah, that hurts your earnings a little bit, but it net negative, it eases out, right? It also pushes, I think it's a net positive because rates also come down, or the expectation for rates come down. Anyway, yeah, we have a lot of stuff coming up here, FOMC meeting. So what I'm going to do, hold on, let me see if they have anything else to say.
A lot of it. No, that part's true,
Okay,
actually.
want to make sure.
But the
Base top-down estimates for the S&P 500 itself, earnings, have been doing nothing but going down. However, where I live, where Jenny lives, individual stocks, I don't care if it's General Motors, JP Morgan, Cleveland Cliffs, these estimates are going up.
Wait.
Okay, yeah. So there's a rotation in the market. Estimates are going up in certain stocks, which is why this is a stock pickers market, right? Tesla's earnings are going to be pretty huge, given the supercharger network back online. Not that supercharger network revenue has came into place, but that record deliveries for Tesla signals better than expected earnings. That's what that actually signals. Now, what we're going to do is we'll take a break. We'll come back in about an hour for the FOMC release, and we'll quickly go over the FOMC release and see, is there anything that changed in the macro data? But for now, we're going to take that break, and I'll be back on to pass on what happens, or to go over the FOMC minutes to see if anything significantly changed. And we'll definitely communicate that. Other than that, appreciate you guys coming on, and I'll see you in about an hour and 15 minutes. We'll be right back on. Get my exit music here. Got to get used to it. How's this one?